Hello, everyone. My name is Philip Leonardo Campo. I am one of two programming coordinators here at Xpace Cultural Center. It's nice to see you. Um, yeah, welcome to our annual tax workshop. We're really happy to have you here today. Um, Sometimes the workshops that we do are either like in person or online, and we just felt like this is a really good place for an online workshop. That way we can reach as many of you as possible. I am your hostess with the mostest, and I'm just going to go ahead and start with some remarks, which include a land acknowledgement. So, this land on which Xbase, we're on site at Xbase right now, operates on has been a site of human activity for 15,000 years, serving as the home of indigenous peoples and nation long before the colonial project. These are the original territories of the Huron-Wendat, the Anishinaabe Nation, the Haudenosaunee Confederacy, the Mississaugas of the Credit First Nations, and the Métis Nation. This territory exists in connection with the One Dish, One Spoon Wampum Belt, a peace treaty established between the Iroquois Confederacy and the Confederacy of the Ojibwe and allied nations to care for the land and the precious resources around the Great Lakes. The dish, and I always do like a dish, representing the land itself, and a spoon, and I always do a little spoon, representing responsibility in sharing its resources. We must continue to uphold this treaty as it addresses the entirety of our relationships and relations. For us, this treaty informs our intention at Xpace to support artists who exist on the margins through public programming and the sharing of additional resources for arts practitioners. Time and time again, we see land acknowledgements feel hollow and automated when performed by institutions. We at Xpace acknowledge that words can only do so much, and we recognize the inherent failure in the limits of the land acknowledgement itself. How they've been co-opted by systems of power. But despite these inherent failings, for us, the land acknowledgement instead has to serve as something that is alive and ever shifting, and able to be completed. So, it's got to be this endless process of change as we commit to always reflecting and responding and learning about what it means to live and work on stolen land. And I'll lastly just say, in regards to my own specific context, I am the son of immigrant parents who moved from Canada from the Philippines in 1989, so 6 years before I was born in 1995, not to date myself. Cultivating new beginnings from the ground up in a new place means that my family and countless other immigrant families specifically, hold our homes with a special kind of reverence. But despite this perceived ownership of land and the complexities of the immigrant experience and conversations about displacement, the relationship is still rooted in colonial ideals, and we're still guests here. I think this isn't talked enough about in immigrant communities, and I didn't realize this until much later in my life. And likewise, I don't think was ever made really apparent to my family, either until recently. And so I think I've just been trying to like unweave these embodied misunderstandings in an effort to better understand my place on this land, who I am as a cultural worker, who I am as an artist and a human being. And we encourage you all to think about your own unique relationship to the land too. Just a little bit about Xpace. We are an artist-run center. We mainly exist as a resource for emerging artists, designers, curators, writers, and other creatives in the city of Toronto. We do that in a myriad of ways. We offer, professional opportunities for artists to exhibit, but we also offer great tangible workshops with real skills like this, or, tenants rights for artists or grant writing for artists. And so yeah, we have design opportunities for designers. We have writing opportunities for writers. We want to fight against the perceived notion that artists don't need to be paid or are only paid in exposure. And so everything that you do with us will be paid. So yeah, we currently are on the last day of a round of exhibitions, but we open our annual high school exhibitions next week. Just because we think emerging means more than just university educated as well. And so those exhibitions open, from what I'm seeing here, on the 11th. And so we really encourage you to come through. Gallery hours are Wednesday to Saturday, 12 to 6. And yes, my physical being has to be there for all of those. So I'll be here. So before I pass it to Kelly, I'm just gonna read your bio, but I guess even before that, just some housekeeping for the meeting itself. Kelly's gonna have a wonderful presentation going after each section. You're welcome to, like, Kelly will check in to see if you have any questions specifically about what was discussed. We recognize that there are going to be a lot of situational questions because you're all coming to this workshop with, your own specific situation in regards to your taxes. We just ask that you write those questions in the chat, and me and Abby, who is with me today, that's Abby, we're in the same room. We're gonna, have a pretty lengthy Q&A section at the end where we read all of those questions that you put into the chat. How that works is, like, we'll just read your question, Kelly will answer, and then I'll leave space for you to unmute yourself if you have a follow-up question. So yeah. And then lastly, before I hand things off, let me introduce Kelly. So Kelly Ross is the Managing Director and CEO of Ross Professional Corporation. She is a member of CPA Canada, leading with strength, knowledge, and passion, having over 20 years of experience in accounting and taxation. Through her career, she has worked in a multinational CPA firm, then moved on to be a subject matter expert for development of an accounting program at a college. Kelly's interest and passion for accounting came from her mother, whose career was in the accounting realm. Kelly has a love for the arts and entertainment industry, which stemmed from having a father who had a talent and love for music. Kelly herself played the piano, trumpet, and was a dancer through her early years. And now in her downtime, Kelly can be found around the hockey rink supporting her daughter's hockey team and following her nephews in their live band performances. She is truly a people person and has a special skill for making everyone she meets feel special. And I'll also just say, I've been at Xpace for a while. I've seen many a tax workshop. I usually kind of tune out just because I have other stuff to do. But I think every year that we've done this with Kelly, I've been so attentive. I think, we're really, really, really grateful to have you. And, it's so informative. And yeah, thank you for being here.
Thank you. It's my pleasure to be here. And really, I want everybody to remember this workshop is for you. And I'm trying to address all the different issues that I believe walking into this that I think each one of you might potentially have as questions or things that might come up for you as you move forward. But feel free to reach out with questions towards the end, even throughout the presentation as we pause on a specific topic to ask for clarity on anything or a little bit more in depth on a certain item that I'm talking about. And I'm happy to do so because I really want everybody to walk away from here learning something and having something they can take into their lives to enact. And of course, don't forget it is tax season. So please, please make sure everybody files their taxes on time. That's going to be my one thing I'm going to tell you to do today. Okay, let's get started. So really today, we're going to talk about taxes that do affect everybody, but then also in particular for your industry. So we're going to get into some very specific items as well that only your industry can do. Am I switching? I don't think my slide's switching. Can you see the next slide? There we go. I think we're good. Okay, great. Okay, so first, let's go through an agenda that we're going to go through. We're going to talk about different types of tax and taxpayers because there is a very different scenario for each one of those. We're also going to talk about what's new. There are some new things that have been happening in the whole CRA government world, and I want to make sure you understand how that's going to impact you and some of your taxes that you're going to be filing on. We're also going to get into some specifics around what you can and can't deduct. If you are someone who has a rental property, we're going to talk about how that will affect you. Or if, let's say, through your journey, you end up deciding to rent out a place that you're staying in now because you're going to be in a new location exhibiting some of your work, whether that be short-term or long-term, what happens at that point in time from your tax perspective. Also, HST, when is the right time for you to register for HST and how that needs to be reported? We'll get into those different aspects. Your filing deadline, so you're on time, because we always want you to be on time. It can be costly if you're not filing on time and you owe any money to the government. So we don't want that to happen. And also we're going to talk about different investment strategies that you can use and how they impact your taxes and why you might want to choose one versus another, whether that be today or in the future. Depending on your situation, my suggestions will change. And then we're also going to talk about audits. Hopefully, I really hope for everybody's sake, none of you ever get audited. But the reality of the situation is it can happen. And when you do find yourself in that situation, I don't want you stressed out. So we're going to talk about how to keep it stress-free for you and how to get through them on the other end. So our types of tax and taxpayers, really it falls into three categories is the main thing. So we've got our individuals, which I'm assuming will be most of you in the room. Even if you have your own self-employed business, you're still going to be considered an individual for tax filing purposes. You'll have to file a T1 tax return. There might be additional schedules you've got to file, like what's called the T2125 to report your self-employment income and expenses. And then you might have sales tax if you're HST registered. If, let's say, you're a parent and you hire a nanny or something like that to watch your children while you are going to be working, then there is a payroll tax component that you might have to register for a payroll tax number and issue out T-slips. If you find yourself in that situation, just let me know and I'm happy to expand more on that. I don't think many people in the room are, or in your homes who might be logging in today, are in that situation. But if you are, I'm happy to expand on that more. If you're incorporated, there might be a time where all of a sudden you're taking off, and I hope that for every single one of you. And there might be a time where you want to consider incorporating. So we'll touch on a little bit about that. And that is a separate filing called a corporate T2 income tax return. Sales tax still exists with HST filings that are separate from that if you are incorporated as well. And payroll tax for you as the owner or any employees that you're going to have will still exist too. Estates and trusts, this is for much later on in your life when you're planning for retirement. That will potentially have a tax filing that you need to do. Or unfortunately, all of us at some point in time, we do pass and there is our estates of what we leave behind that's going to have a tax filing that will have some reporting to do on that end as well. So really three different sections of types of filings you could end up in. Today, we're going to really focus in on the individual side and then just briefly touch on some of the others just for certain things to think about. So let's first get into what's new. So quite a bit has been happening, as you can see from this list on here today, that has changed a little bit in the world. So if you are an employee, for example, and you're receiving T4 income from anyone, you might have noticed this year on your T4 slip that there's additional box on there for CPP2. And what this is an enhanced deduction where employees are getting withholdings of additional amount of CPP towards their Canada pension plan to pull down on at a later point in time when you retire. So this is an additional 4% that you would have seen as being withheld on your taxes this year. I don't know if any of you have been keeping up to speed with this whole capital gains rate change that's been going on. Originally in June, they were planning on changing this where any capital gains that you were to have to report on your tax return. So capital gains are like if you sell property or stocks, for example, there is only 50% that gets taxable on there for the gains that you receive. So any income you receive on that. And the whole thing that came into play that was supposed to roll in June, which is now deferred to January 2026, is changing that rate from the 50% to the 66.67%. So a little bit more going to be taxed on you here for these. So this is now deferred till January, but you will see in some of the slips that you would have received this year that there's 2 boxes for capital gains, and that's what they're doing in there because the government changed their mind on this whole thing a little too late in the systems that a lot of people were not prepared to be able to revert back their systems to just report it on the one line again this year. So they've done pre-June and post-June, but it's all still treated the same way for 2024. When you buy a home, there's a home buyer's plan that's been in existence for quite some time that you can borrow off of your RSPs. What's new around this is in 2024 on April 16th, they raised the amount you could pull off of your RSPs from $35,000 to $60,000 that you have to repay back. So that's a new measure that came out. Home buyer's amount, you also get an additional tax deduction. This came out a year prior as well, but it just as a reminder, when you do buy a home, you can get an additional $10,000 deduction on your tax return in that year. And this is the government's way of trying to make it a little easier for people to buy homes now because they're recognizing that it is a lot more costly and a lot more expensive for people. So they're trying to alleviate that as much as possible. If you have any accessibility issues mobily, and you have to set up anything in your home. They've also introduced a tax credit with respect to that for elderly who are 65 plus or have a disability tax credit. And that's of any age if you have a disability tax credit that you're allowed to have, and up to $20,000, which equates from a overall tax savings of about $3,000 a year. There's also this multi-generational home renovation tax credit, and this is in relation, again, because of the affordability of homes, where if people are now living in the same property and they've had to renovate in order to accommodate that, and there's like a separate entrance and whatnot for that additional family unit that's going to be staying there, you're allowed to take a deduction for up to $50,000 worth of those renovations, and that equates to about a $7,500 credit, tax credit that you can have on your taxes as well. Also, if any of you are working in the digital platform space, I'm not going to get into it today, but by January of 2025 this year, there was some new reporting rules with respect to you. So if you haven't looked into those, that's something you might want to look into. Also some stuff on short-term rentals, which we'll talk about again a little bit later. If anybody is out there volunteering to do with firefighters and rescue areas, which would be amazing, but also sounds very dangerous to me. But if you do, the government will give you a credit of $3,000 to $6,000 a year if it's over. It's raised from $3,000 that they had prior to $6,000 if you're volunteering for more than 200 hours a year. That's a lot of hours. That's like a lot. So I do think it's worth that. So even though you're not getting paid because you're volunteering, at least in this way you kind of are, because you're going to get that tax break with respect to that. Child tax benefits, there's a 6-month extension. I hope nobody's ever in this position where you have to watch your child pass. But if so, they are extending that. You can still continue to receive that now for an additional 6 months, which wasn't there ever before. And there's this new Ontario Opportunities Funds. Just in case you feel like our government needs more help than some of the other charities out there, they are giving you the opportunity to give them some money to help get our debt down. I don't know many people who want to do that, but if you would like to do that, just know you have that option and the government's going to give you that ability. And also something new is if you ever owe CRA over $10,000 and you're making a payment to them, something new they came out with this year was you can only make those payments electronically. You can't send them a check like you might have been able to do in the past. If you don't feel comfortable making those electronic payments, you can always bring a check into the bank to do it and they'll send it in for you electronically. So I have seen a few people who have tried to still send the check and they got penalized for it. So I just wanted to highlight that piece today.
Kelly, before we
Yeah,
proceed, I have a question in the chat that isn't quite about what you were speaking about, nor is it situational, but it kind of is a good
yeah,
question overall.
sure.
Lee asks, I'm just wondering if this workshop would be helpful for someone living and filing in BC and Quebec.
Yes, it would be. So your tax rates are going to be a little bit different, but the concept is still the same. So yeah, from an overall tax perspective, yes, 100%. If there's something very specific to your province that might be an additional measure, that I won't have. But as far as teaching you how to do your taxes and the type of deductions you can take, absolutely, it's all going to apply. I do taxes for people in different provinces throughout Canada, and everything that we're going to talk about, unless I specifically say in Ontario, is going to be for every province in Canada. So you're good.
Great. Thanks, Kelly. Please feel
You're
free to
welcome.
resume. Lee, hope you found that helpful.
Excellent. Anything else before I continue? No, we're good. Okay, excellent. Okay, if you're incorporated, there's not really much going on. I really had to pull at trying to find something that I could throw into this category for what's new. But really, the only things that are in here is to do with really large corporations. The only thing that might potentially affect anybody is in Ontario came out with a computer animation and special effects credit. That if you spent over $25,000 to implement something like this, that potentially there could be something in there for you. So just something to look into. Estates and trusts. So if you happen to be have a trust set up, or maybe you are the beneficiary of a trust, one of the new things, or you're an executor of a trust, helping to facilitate any of that. One of the newest requirements in there is a Schedule 15 requirement. And what this is it talks about who the actual beneficiaries are of the trust, or specified beneficiaries. This was not something you had to always report on a regular basis. And you would have not necessarily had to file a return every year if you didn't have any taxes due. But the Schedule 15 requirement now makes that something that you do need to report on. And if you don't, they will charge $25 a day up to $2,500 a year as a penalty if you're not filing those. So just a heads up to let you know that you should be doing that. Normally, trusts and estate returns are due 3 months after the year end. Most of them are calendar year, so that would be March 31st. This year, they have extended to waive some of the interest and penalties in relation to the capital gains rate change. So you do still have some time to do that if you did miss that timeline. There was a Bear Trust related thing where I'm not going to get into that today, but they've caused so much confusion around it that they've taken it away and deferred it for now as far as implementing it. And again, the capital gains change is delayed again till January. But now let's get into some meaty stuff, some stuff you can start to use and save yourself from money and make sure you're reporting all your income well. So individuals, so we're going to talk about from your personal taxes. This is your personal T1 income tax return. So even before you were self-employed, you would have had to file a personal income tax return, T1 return, for any sources of income you would have received. So becoming self-employed, if you still have any other income you're receiving, you were still reported on the same return. So that's a really important piece of information. All of it goes into this return now. You're just reporting them in different areas on it. So you might be reporting employment income, investment income. So your investment income could be stuff like interest, even in your bank account, you might receive a T5 slip for. If you have withdrawn any money off of RSPs you have saved up, it doesn't count for anything on your TFSA accounts, so your tax-free savings accounts, because those are tax-free. So you don't have to report those on your income tax. If you had any stocks that you might have bought and sold, you would report those in there as well. Pension income, if you're up at that age, I don't think anybody on this one is, but if you are, then if you have any pension income, it would report too. If you ever collected EI or workers' compensation, income on that would be reported. Grants are an interesting one, and this one comes up a lot in questions that I get from people that they've received a grant. Majority of the grants are taxable, so that's important to understand. Where you can get exemptions from the tax side of having to pay it on your income tax is, well, one, if you're enrolled in school, you usually do get an exemption for it while you're in school. So and the way you would prove that is if you have like an enrollment letter, or if you have like a T2202 that you can pull down off of the website of the institution that you're with, will show that you're registered in an educational institution, and it's if that course is related to the grant type you've received. So for example, if you're taking courses in a school in relation to being an artist, and then you get an artist grant, then that's how it can become exempt at that time. Now, if you're receiving grants outside of that and you're not registered in an institution at that point in time, it does become taxable. However, you can offset any of the income that you've received from those grants with any expenses you've used that are considered eligible expenses to use that grant money for. So in essence, if you had received a grant for $10,000 and you had $10,000 worth of expenses, you can offset it and you pay no tax on it and everything's fine. And there's no additional income to report. Now, let's say you receive the money this year, but you don't actually have the expenses till next year. Well, the way it works for that is you do still have to report the income in the year you receive it. However, you can always go back and amend your return or file what's called a T1 adjustment to your return to then claim the expenses back to the year prior to match against that income that is there. So you're allowed to deduct expenses for the year ahead, the year after you received the income, and also the year of receiving from the time you received approval for that grant. You're allowed to deduct in there. Now, let's say you're filing your return. Now, it's April. You received the grant, so April 2025. You received the grant in 2024. Let's say you received it in June 2024. Well, if you've incurred any expenses as well between January and April of 2025, you can put that in your 2024 return because you know those expenses have happened and you can list that to offset that income in there. Now, there is also another type of grant that I've seen happen where it's important to read the contracts. because usually the grant income that is taxable, you're going to receive a tax slip for to report that income. Now, if you don't receive a tax slip, you might want to go back and check what type of grant it actually was. So for example, one in particular I can think of that falls under this is in the film industry, for example, where they have a grant you receive to help you create something to release it. Now, if it doesn't actually go out to production, then it's considered a loan until it actually does. And then you've got to repay the loan if it goes back to production. But if it never goes to production, then it's considered like a forgivable loan and you don't have to pay it back. So basically, in those situations, it's not really income. It's considered a loan on your books until potentially a date where you might have to pay it back. So that you don't have to bring into income. So it's really what I'm getting at here with the grants is that there's so many components to it. So it's really important to understand what type of grant it is you have. What are the conditions around that? If there's anything in there saying there's a chance you might have to repay it, you don't have to bring it into income because you might have to repay it later. If it doesn't say that and it is strictly just a grant for something for you to be spending and offsetting expenses for, then just make sure you're offsetting those expenses against it. And whatever the difference is between the amount you received and the expenses going out is what you're claiming as income on your tax return. Hopefully that's clear. I know that's a really tough one. I'm going to pause for a second on that because I know I get a lot of questions around that and I want to make sure I'm being clear with people. Does anybody have a question around the grants they want to ask?
Yeah, feel free to unmute yourself.
I had a question that
Mhm.
so for the grant as income, I worked for a non I'm just reading off what the text I sent, but I worked for a nonprofit where I was paid using grant money. So I was in charge of like the expenses and the invoices, but I got reimbursements for all those expenses related to the grant. How do I like report this? Would it just be the income that I received from the grant, or would I report the expenses as well, even though I was reimbursed?
If you were reimbursed, you wouldn't include the expenses in there. You
Okay.
just include what you received in your pocket. You can
Okay.
only offset that income against any expenses you personally had to pay.
Okay. Would travel expenses count as that?
Yes, travel does usually, unless there's something to do with the grant when you got it that restricted you from being able to consider that an eligible expense. But
Ah,
most grants that I see coming through there usually do allow the travel expenses if it's directly in relation to you doing that. So, for example, like a research grant that they might have
mhm.
would have the ability for travel because to research, usually you have to go somewhere else.
Beautiful. Okay, thank you.
Yeah, you're welcome. Any other questions on that?
Hi, can we just ask?
Yeah, go for it.
So I received a couple of grants this year, but I don't technically know if I qualify as self-employed because I don't sell my art, but on the other hand, I did teach art, and so I have $2,000 on my, like all of my grants and all of my teaching all is because of this artist work. So I'm just not entirely sure how to put that on my
So
tax.
how does your other income come in? Like, do you like, is it T Ford, like the teaching
Yeah,
income, for example?
yeah.
Okay, so then what you can do is if you don't have any actual self-employment income that isn't regular employment T4 income, instead of reporting it on like a T2125, you would report it on line 130 of your return. And that's where it's other income. That's the line item that you put it on. And in fact, most grants, that's where you're really supposed to be reporting it is on line 130. If it's a grant that comes into box 104 or 105 on the T4A slip that they issue you.
Okay, so I should not declare self-employment. I should declare other income.
Yeah.
Okay.
If it came in on the, like, do you have a slip for this grant income that you received?
Yeah,
Yeah. Is it a box 104 or 105 amount?
I'm not sure.
Double check, because if it is, then it would go into on line 130. If the income that you received was in a box 28 or 48, then you're going to have to put it on a 2125. That's the distinction of where you put it on the return.
Okay, so I don't have to declare self-employment, but I can still declare work expenses.
work expenses only if you have self-employment income, right? Or if you were T4'd as an employee and those are your work expenses, then those work expenses would be if you received what's called a T2200, which is a statement of declaration of employment expenses, approval for that from the employer, then you can do it on what's called a T777, which is other employment deductions. So it depends on how you're receiving your income is where you put your expenses. So if you have self-employed income, or if you have that grant that's on a box 28 or 48, you can put it on the T2125 to bring the income in to then offset the expenses.
Okay.
But if it's related to the grant, then what you're doing is offsetting the grant money on line 130, your income minus the expense amount, and then that's the amount you're going to claim as the income. Does that make sense?
I think so.
Okay, if you have a follow-up question or you want to ask me again later, feel free to, and I'm happy to clarify it.
Yeah, before we just continue, just because we've had a couple of like latecomers, for questions after these sections, if they could just be about like what clarification on information that was shared, that would be great. Please save all really situational questions for the Q&A session at the end. You're welcome to just put that in the chat, and we're gonna have a really lengthy session where we just read through and give Kelly the chance to address your specific context in that area. But just so we can like move through the presentation with a little more speed.
Okay, sounds good. Okay, so now let's get into self-employed income. So self-employed income, we were just talking about, so that's any of the income that's not being received on tax slips regularly. Or you might receive it on T4A slips and they're issuing it to you as self-employed income in like a box 28 or 48. That's really the income you're going to report on that form. And this is also where you're going to offset expenses, which we'll get into afterwards as well. Rental income, I had touched on the fact that if you end up renting out your place for some reason because you're not going to be using it, you'd have to claim that income that's coming in. And again, there's offsetting expenses you can use for that. Also, there could be people who are coming to Canada, but they might have had income from where they were coming from, or they might have relatives outside of Canada who have left them something in their wills or something, and they're generating income from outside of Canada. What's important to know is wherever you're considered a tax resident, so where you're living, you have to report worldwide income. So all income sources you have, but if you pay tax in any other country or any other jurisdiction, then you get an offsetting foreign tax credit for that to offset it so you're not double taxed at any point in time. Usually there'll be still a little incremental amount that you still have to pay on that income, mainly because Canada does have one of the highest tax brackets in the world, unfortunately. But so only for that reason might you have some extra tax to pay on that. It's not that you're getting taxed on the same money you got taxed on somewhere else. You would get an offsetting credit for that. Let's say you were married and you received and you divorced that person, or you have a child with somebody else and you might be receiving support, for example. Well, child support, you don't have to report on your income tax return, but spousal support you do. So if there is any spousal support income that you are receiving of any sort, you do have to claim that on your tax return as well. Also, if you find yourself in an unfortunate situation where you are forced to withdraw money off of your RSPs you've been saving, that is considered income to you as well on your taxes. So now we've talked about all the income that comes in. Now let's talk about all the deductions, because I want to make sure you can keep as much in your pocket and not give it to our government. So if you are an employee and you're only receiving T4 income, so not T4A, but T4 income as an employee, see if there's a way for you to get what's called the T2200. If they're willing to issue you this, which is basically a form that declares employment conditions and the requirement for you to pay out of pocket for some expenses, or you work from home, for example, then this will allow you, based on what boxes they check on here, to be able to deduct some expenses off of your income. And this can save you a lot of money, and especially if you have a vehicle you've got to be traveling for, working from home. So a portion of all the expenses related to running that home, like your utilities, if it's rent you're paying, or if you're receiving commissions, then you can also do property tax or insurance, but only if you're a commissioned employee. But there's so many different things that you can offset to help really with your living costs that are happening if you're working out of that home. Also, maybe you have to buy some supplies, or you've got to take some people, you're taking some people out for meals or anything like that. There's different deductions you can take on there. So really worth asking for that form if you can. Now, let's say you have investment income that you're reporting. So you can deduct investment expenses against any of that income. So let's say you're paying a financial advisory fee for something in order to generate that income that's being done. You've got somebody managing the portfolio for you. Any of their fees related to that, well, not all the fees, but specific fees related to that can get deducted against that income that you're claiming, because you had to pay something in order to generate that, and that's why they're getting the fee that they're getting. As well as if you had to get any legal advice to do with any of that investment income on the best ways to do it, or you've been paying an accountant for anything, those are all expenses you can offset against that type of income as well. Grants we did talk about, so I'm not going to get into that. Now, there's 3 R's that I really want you to think about all the time when it comes to being self-employed. So ask yourself whenever you're incurring an expense, and I actually challenge you to do this if you've never done it before, is go through like a week of your life, and every time you pull out your wallet to spend money on anything, I want you to ask yourself these 3 questions. 1, am I getting a receipt for this? 2, would this be reasonable in nature in respect to what it is that I generate income off of? And 3, is this related somehow to that work that I'm doing? You'd be surprised how many things you don't deduct today that you probably can be when you ask yourself these 3 questions. So while we are going to go into some very specific types of expenses, there's always things that don't always fit the categories. And this is where you can always come back and ask yourself these 3 things. So would I incur this expense if I was not generating this income? If I was not trying to do this self-employed business I have to generate income, would I have to incur this expense? So I challenge you to do that as you start to spend over the next week, 2 weeks, 3 weeks. You know what? Do it every day if you can get into the habit of it, until it just comes second nature to you. And you'd be surprised how many more things you start tracking moving forward. Might be a little late for some of them because you might have thrown out the receipt, because you do need a receipt to be able to prove you made that expense. But I do challenge you to do that as much as you can. But let's get into some specifics. So first, now, do you have a vehicle that you're using, that you own and you're using to travel to do stuff to generate this self-employed income of yours? So this could be going and picking up supplies. It could be delivering stuff. It could be going from location to location in order to do and generate different types of income that you've got. It could be even driving to go and have a meeting with somebody. All of this, if you're using your vehicle, can cause deductions for you on the tax side. So what you need to do is start tracking. And when I say tracking, I don't mean just the times of when you're actually going to do these different things. I mean for the entire year, all the time. So you don't have to track it by the trip or whatever that's happening through there. The only thing you'll track there is mileage, which we'll get into. But all these receipts for these categories, you got to keep track of it for the entire year, and then we ratio it as far as how much you can deduct. So every time you put gas in your car, if you do an oil change, if you do any types of maintenance on that vehicle, actually. So if you have to go and you have a flat tire, you got to go and deal with the tire issue. Let's say you need to go and have, what else could be going on? Maybe you need a new battery in the car. All of these different things are expenses that you can take a ratio of to deduct for your taxes. Maybe you don't own it full out right now and you had to get a car loan with respect to that. Any interest related to those payments, you can take deductions for. Let's say instead of buying it, you leased it. So there'd be lease payments you can do, and there's a maximum threshold of how much you can deduct each year, but you can take deductions from the lease perspective side for those lease payments happening. License and registration. So if you've had to pay anything, I mean, we don't have to pay for it anymore, where you used to have to always do the stickers for your license plates when you do your renewals, but maybe you've had to renew your driver's license and pay for that. So there'd be a fee related to that you can take a deduction for. Any insurance on that vehicle, because that can be quite costly. and any parking and stuff when you're parking in different aspects. So you can take deductions for all of this stuff. So now the way it works for your taxes is you have to track by mileage. And that's one of the first things that CRA will ask you for if they ever have questions around the deductions you're taking for your vehicle. Is the first thing they'll say is, send me your mileage log. And the first piece of advice I'll give you around that is never say, no, I don't have a mileage log. Go and find your mileage log. And at the very least, if for some reason in your return you had done a percentage based off of the top of your head, go and create it based on your calendar of events of where you were at all those different times to come up with what that mileage log looks like. But the easiest way to do it is to be ahead of it. And one thing I do, which makes my life a lot easier, is I have an app on my phone, for example. I personally like the MileIQ app, but there's so many of them out there. MileIQ, I think, does have a monthly charge to it. There are some, I think, that are free out there too. But it makes it so easy because every time you're in a vehicle, it senses you're driving, and you can classify the trip by swiping either left or swiping right. And by doing that, like left could be business, right could be personal. I can't remember which way is which, but one way is one and one's the other. And then it'll send you a report at the end telling you, I think it's monthly, they send the reports, and it'll say you drove this many miles or kilometers for business and this amount for personal. And then that's the ratio you use. So let's say you drove 100 kilometers out of 1,000 kilometers for the year related to business. So you would take your 100 divided by the 1,000 to come up with 10%. And basically 10% of all of those items that we've just gone through becomes a tax deduction for you. So it can be quite significant. And I've seen in scenarios where some people, they're as high as like 90%, 95%. So just imagine the deductions you can take there against the income that you have. So it can really add up. Definitely worth doing the tracking, and make sure you keep your receipts. Always keep your receipts. You don't have to send them in with your taxes, but you have to be able to produce them very quickly when they do ask for them. Now, let's say you're running your operations out of your home. So this is where another really big deduction can come up. And again, it's ratioed, similar to like how the automobile is, except it's not based on mileage, it's based on square footage. So let's say you have a home, and let's use the same ratio. Let's say 10%. Let's say 100 square feet out of 1,000 square feet size is your home office that you've got that you're using primarily for business. Then all of the expenses related to that home you can take deductions for. So if you've got any of your utility bills that you've got, any insurance, any maintenance or repairs, as long as they're not structural, you can do property taxes if you own it, rent if you don't own it and you're renting it. So that can be quite a significant number, like your water bills. Maybe even you have somebody who comes in and cleans the office, and that portion of it can happen and take a deduction for too. So again, this can add up. You're only allowed to take home office expenses, though, to offset income. It can't put you into a loss position, but you can carry forward those expenses. So even in years when your income is not high, you want to still track these so you can use it for future. So always a good idea to still keep tracking it, because it can add up at a later time when you land a big contract, which I hope for all of you. Now let's talk about ones outside of the home office and the automobile side, and the different types of categories that you're going to be reporting on. So advertising, promotion, and gifts. So you can take deductions for these things that you are giving for people, if there's some sort of a business purpose related to them. And what I mean by that is so let's say you're trying to congratulate somebody who's within your field, that could be a potential connector for you for income that's going to be coming in. Maybe you're putting an ad in, or you're making a donation to somebody or a group, or that's going to be helping out other people in your industry, even outside of your industry, but it's getting your name out there. All of those things are going to be deductions for you. Where you need to be more careful, though, on there is when it comes to anything to do with meals and entertainment. So even when you're gifting, for example, if you want to always think of, always give from your heart and give what you feel you need to do. But if you're looking at it from a tax perspective, it's better for you to give a gift that's not related to food and drink, for example, because if it's a gift card towards one of those, then it falls into that category of business meals and entertainment and is only 50% deduction for you if it's a gift card related to those different aspects. Now, you also have the ability, if you are taking somebody out for coffee, taking somebody out for a drink, taking somebody out for lunch, dinner, whatever it may be, to again explore business opportunities, to thank them for something, to talk about business transactions that are currently going on. All of these, if you're paying the bill, is going to be 50% deductible for tax purposes too. So you want to be tracking that as well. Bank and credit card interest. So one of the biggest tips I'm going to give you when it comes to being self-employed is have a separate bank account. Separate bank account from your personal bank account to put all of your business operations in. So I want you to be putting in all of your income that's related to self-employed into there, spending the money for the expenses out of there. And there's two reasons for this, two main reasons. One being any service charges or interest even on a credit card, because I want you to have a separate credit card for this too. If you're carrying a balance at any point in time, now you've just made that a deductible expense for you. So any interest charges related to any of that. If it's on a personal credit card that's merged with all the other stuff, you can't really take that deduction. I mean, you could if you could really quantify exactly what portion of it relates to, but that calculation you'd have to go through to figure that out is going to be very complicated. But this can be significant if you're ever carrying over a balance on the credit card and any of those charges. But the most important reason is outside of that, which is if ever CRA is asking for information and proof on anything, you do not want to be giving them your personal bank statements. They don't need to be seeing any of the stuff you're doing on a personal nature, because then they're going to get into every single deposit that has ever happened through that bank account and start questioning you about it. And you're going to have to prove them it's not self-employed income. So if you're getting any money, even as a gift from your mom, from your friend for your birthday, and they're sending you $50, $100, you're going to have to prove that that's not income. So this is why you want to be able to keep two separate accounts. So it's very clear what's come in and what's come out for the business. It doesn't mean that you can never do something and pay for something personally as well, but for sure, make sure all the income's going through the business bank account. And then just account for anything that you didn't have the business card for, or there was no money in that account at some point, you had to use another one separately. But very important to keep it very segregated, so CRA is not having to look into your personal business, because that just overcomplicates situations. Association dues and fees. So if you're affiliated with any groups and there's any fees you're paying for that are related to the industry of your business, you can take deductions for those. If you're affiliated with a union, same thing, you can take deductions for that too. Don't always forget about office stationery and notepads and all the little stuff that you might buy, even a mouse for your computer. Like, these are things you're going to want to be able to take deductions for, right? It's the little things, right? And when you start asking yourself those 3 R's, like I mentioned earlier, you're going to see how many things even along those lines might come up, even headphones. So you can listen and do a meeting like this, for example, on your headphones in a public space or something like that. So you're not disturbing other people. There's a lot of different expenses that might come up. Any materials and supplies you need in order to generate that income and do your job. So I'll use a painter, for example, someone who paints for a living and does sketches and all that type of stuff. So you're going to have paintbrushes, you're going to have paint, you're going to have your sketchbooks, you're going to have your charcoals, you're going to have all those different things that you have to have in your capacity and at your range at any point in time, in order when the drive hits you and the inspiration hits you, for you to be able to create something and generate that income. So you want to make sure you're deducting all those expenses along the way, even when, and that may even fall in a period when you're not generating income, but it's for future income. And that's okay. You can take those deductions. The one thing that you will want to watch, though, and I'll bring up, is you want to make sure you're not claiming losses for too many years in a row, because that is an area that does get spiked by CRA to kind of look closer at things and challenge you on whether it's really a business or a hobby. So where you want to watch is not to show a loss for a third year in a 5-year period. It's okay to show a loss for 2, but don't show it for 3 in 5 years. Just hold on to some of those expenses. Just don't deduct all of them at that point in time. And just start maybe being a little more cautious as to how much you're spending in those years when those losses and that income's not coming in, okay? Just because you don't want to bring scrutiny to yourself and what you're doing, which that would do if you're going to be reporting those losses. And the reason that they do look into that more on the personal side, the corporate side, they're a lot less worried about it. Personal side is because if you have other sources of income, it's offsetting taxes you've paid on other types of income, for example. So it's giving you a benefit somewhere else. On the corporate side, for example, it's not. If it's not going to apply against other income you've received in a different year, it's not going to do anything for you except to move forward that loss to a future year when you are generating the income. But that year it wouldn't bring you the benefit. Okay, so I digressed. So I'm going to come back onto track. So accounting and legal expenses. So if you're paying an accountant or you have a lawyer, review contracts that you're getting into, which I do highly recommend. Before you sign things, you should always have a lawyer or paralegal or somebody take a look at those documents, especially if you're not familiar with them, just to make sure you know what you're signing, especially if they're really large contracts or they're very restrictive contracts. You want to know what you're getting into. Agent commissions and management fees. So if, let's say, you're working with an agent or a business manager of some sort, or somebody who's going to be referring business to you and there's a commission base attached to it, any fees related to that you want to do. And just make sure when you're reporting your income before their fee. So if they're holding it off the top, you're still showing your fee above that and then taking the deduction. So you'll end up in the same place, but it's just a lot cleaner from a reporting perspective to show your gross income properly. Office or studio rental. So let's say instead of working from your home, you're renting a space that you're using. And it could even just be periodic. So not on a regular monthly basis, but it could be for half a day, once a week, or something like that. And there's some sort of a fee related to that. Well, you take deductions for that too. Repairs and maintenance, this can fall on any of the equipment you've got. So let's say you've got a camera or a computer and something's gone wonky with it and you've had to take it in to get repaired. Any expenses related to that you want to be including, as well as the item itself. So don't forget, if you're buying equipment, that you're going to take deductions for that. As a rule of thumb, there are so many different types of things that you can't take full expenses for, and you have to do what's called capitalizing and taking it over multiple years of a deduction. It's called capital cost deduction, capital cost allowance. And if you look it up in on the CRA website, it'll tell you the different rates based on the different type you've got in there. But basically, it's anything that's really over $500 that you're buying is when you really got to start to think about it. If it's under $500, don't worry about it. But if you're buying a large piece of equipment, like let's say you're buying an Apple computer, we know those are not cheap. They are not under $500 as much as we might hope they are. They are not. So we do have to spend a little bit more money on those. So over a multitude of years is where you would take a deduction for that. There is actually a measure in right now that allows you to take the full deduction for the year, but that is going away soon. So that might not be a good example, but let's say you have maybe bought a camera. So over a multitude of years, you might be able to take like a 20% deduction on that if it's something that you bought that costs over the $500. So just be wary of that, to look that up if you need to capitalize it. But definitely take deductions for any of those different pieces of equipment that you're having to buy, or any computer related stuff that you need to do. Travel and lodging. So, and this is both within and outside of Canada. So let's say you've had to travel for business, and sometimes it might not even necessarily be for generating the income at that time too. So yes, you might get some sort of a contract where you've got to go do something and exhibit something somewhere else, or they're hiring you to do a talk or do something along those lines. Then yes, while you're there, any of that travel and accommodation and meals that you have while you're there are going to be deductible for you. But also there might be research involved. So let's say there's something that you want to bid on to try and get a contract for, and it's very specific. So let's say there's something with the whole aspect of like the French Riviera, for example. Then you're going to have to go see it. Right? So you're going to have to do some travel to make sure you've really embraced yourself and embodied yourself in that environment in order to then go pitch that. So you can have the most research behind you in order to walk into that situation. So those types of things, if you can justify them to something you're going out for to try and generate income off of, those can become deductions for you. Now, if you're bringing somebody else with you, that's okay. But you have to factor that in as far as what becomes deductible and not. So if there's two of you, then all of their stuff is not going to be tax deductions for you. Only yours will be. So if you flew somewhere to go and check out a place, only your airfare is going to be deductible. Only your food, only your portion of the hotel room is going to be. So just take your proper ratios when it comes to those different aspects. Now there's also the phone. So like your cell phone, I know for me, for example, this thing's always attached to me and it is always going off in relation to business activity. So it would be a deduction to me. So if you have, but if you only have one phone and you use it both for business and personal, you have to figure out what your ratio is with respect to how much it's being used for business versus personal. So let's say it's 50-50. So half of your deduction of all of your cell phone bills, for example, would be a deduction for you here. Same thing with like internet, cable, streaming services. So if you can relate the streaming services that you are streaming or any other software related items to anything that you're doing for work or you're trying to bid on work for, then you can take a deduction for that. Just keep in mind with streaming services, for example. So let's say, and when I'm talking streaming, I'm talking like your Disney Channel, your Paramount Plus, your Netflix, your Crave, all of those subscriptions, they can be deductions if you're in the TV and film industry, for example. They can be deductions if you're in animation and all those different items, but you've got to also figure out how it ties to it and then factor in who's using it and what they're using it for. So if, for example, you have 5 users on there, then only 20% of that can be deductible under you as a maximum because there's 5 users on that account, for example. Now, if you're the heaviest user and you can somehow justify a ratio that's higher than that, that's fine. But you just want to know that there's going to be that kind of an analysis done on the deductibility for that service that you're doing. So just be reasonable with it as far as how much it's actually being used for business versus personal use. Professional development. So any like coaching, classes, workshops, anything you're paying fees towards, take deductions for that as long as it relates to the industry again, or something to better yourself in order to be able to generate that income. So for example, you might want to take something, maybe you want to take a course in a foreign language, and that's so you can relate yourself more with other people from that country or speak that language, or maybe you're trying to get into a market with that dialect, for example, or you're trying to bid for, again, another contract that requires you to speak that language. So these are all justifiable ways to kind of get that deduction that's going in there, or you're trying to be a better public speaker. So you're taking a public speaking course, or maybe you're trying to center yourself and get your mindset in the right spot it needs to be. Again, if you can somehow relate it to what it is you're doing and the income that you're generating, then absolutely you can take the deductions for it. You just need to be able to talk about how it's going to be a business deduction for you. A lot of it when it comes to audits is all around that. It's, can you justify the expense? And if you can, then you're just fine. If you can't, then they'll disallow it. So just make sure you speak up for yourself on those. Any other research? So we talked about this from the travels perspective, but there also could be books, subscriptions you're doing, any different aspects to different things, even music that could be somehow related to that income. So again, tie it back to the specifics of what it is that you're doing. Any other local transportation. So whether you own a vehicle or not, if you've had to take any Ubers, taxis, any subways, buses, anything along those lines, you can take deductions for those too. Any other public, any professional subscriptions or publications, magazines, any types of things along those lines. Business wardrobe is a tricky one. So again, depending on how it is. So not every industry out there can say they have an argument for, like even myself as an accountant, I could say I have an argument to be able to write off my suits because I can't walk into the office and be in front of a client without a business suit on. Well, no, I can't take a deduction for those. As much as I would love to, I cannot. However, in the arts and entertainment industry, for example, there are situations where you can do this, because if you have to be in front of a camera, for example, and you've had to purchase, and not even just in front of a camera, maybe publicly, recording wise, even for performances and stuff like theater and all those different aspects. Like you can write off anything you need in order to be in front of that camera, for example, if it hasn't been provided for you, or accessorize, or do your hair under those situations, do your nails, all those different things. But the upkeep related to those, you can't do deductions for. And they can't be things, if you're buying articles of clothing that you're also going to wear on a regular day on the street. It has to be related specifically to when you're in front of that camera, and that's the only time it's being used for under those conditions. So, and you have to be reasonable. Be very reasonable about it when you're doing it. Don't try and do everything that's in your closet, because you're not going to be able to get away with that. Now, let's say you're doing something that's in inclement weather, for example, the middle of the winter, and you're going to have to be outdoors doing these different things, and you're going to have to figure out a way to stay warm. Well, anything you require in order to be in those conditions, maybe you've got a little block heater or something that you've set up in there. You've had to do an extra warm jacket or something in order to keep yourself warm, or extra mittens or something along those lines, something extra outside of the ordinary that you would normally do in order to be in those conditions. Again, those can be deductions as long as they're not your everyday wear. So you have to be able to make that distinction between regular everyday wear type of clothes that you would have had versus very specific, had to be bought for this purpose. And that's what it's only going to be used for, to be able to take those deductions. But you definitely can. And these are areas where they are looked at with a lot more scrutiny from CRA. But in the arts and entertainment industry, usually you can justify this as long as you're strong enough in your argument, and you can do it exactly the way I just described, which was being able to directly relate it to that different aspect. So we talked about the stage makeup and hair to do with that too. Any headshots, tapes, recordings, anything along those things you're doing, again, to get yourself out there and be able to promote yourself, really important to do. Any other types of professional services that you've had to hire. We talked about lawyers, accountants, we talked about classes, but really I just throw in the general category here because there really could be so many other things that might come about, like I'm trying to think of something else. Like maybe you're wanting to learn how to sketch better or something, and you're taking something like that, and you've hired somebody to do better for that. Or maybe you've hired somebody to do a certain portion of the type of jobs that you're trying to collect on and generate income on, but you need somebody else's help to facilitate some of the services that you're going to be offering. So that might be somebody you're hiring as well. That would be like a subcontractor for you. Also, if you have any health insurance premiums that you're paying into, I mean, everybody as an individual can deduct these as medical expenses on their tax returns, but as a self-employed person, you have the ability to actually deduct it and get a higher, like a full dollar value offset if you have enough income for it, and it's not going to put you into a loss position. So there is a lot more you can deduct on this section, for sure. Next is rental. Do you think this is a good pausing for a quick little break?
Yeah, how are you feeling?
Yeah, why don't we take 5 and come back in 5?
There are a couple of questions that do relate to clarifying things, but maybe we could ask that after.
Oh, we can do it right now. Let's do the questions, okay, and then we'll take a 5-minute break.
Okay, that sounds good. So the 2 questions that we flagged is just trying to clarify things from this section. We've got Julia who asks, for home expense deductions for self-employment, is the percentage related to the proportion of your income generated from self-employment, i.e. if you have a mix of income like a T4 or a T4A?
Yes and no, depending on the angle you're asking me that question from. So let me clarify. So if the home office, let's say if 10% of your space is only used for the self-employment working from home, then it doesn't matter how much income it is. It's that space is dedicated fully for just being used for self-employment income. Now, if you have employment income too, and you're working from home for employment income and self-employment income, then you have to split it up and you'll take a smaller ratio for it. But if it's only self-employment income you're using that space for, then you don't have to ratio it based on the income that you're receiving.
Okay, Julia, how was that? You're welcome to unmute yourself if you got a follow-up question.
That clarifies it. Thank you so much, Kelly.
Oh, you're welcome.
And then before we go on break, Claire just asks, to clarify, a loss is when the expenses you claim are higher than the income you're claiming?
Yes, correct. So it would be when you put yourself into when you're trying to claim more expensive than income, which, as I mentioned, is okay to do. Just don't put yourself in that position 3 years within a 5-year period. The third year is when it'll spike questions, or making it too unreasonably large. Like little losses are okay, but if you're only making 5,000 of income and you're claiming a $20,000 loss, like no, you're just asking for trouble. So be reasonable. Be reasonable in some of the stuff you're doing.
And then lastly, we're just seeing one right now. Do e-transfer screenshots for a workshop count as a receipt?
From an income tax perspective, you could probably get away with it. I mean, a receipt is better, but if you only have the e-transfer receipt, I personally would take the deduction because you did make that payment, as long as you have something that shows what it was for. So I would keep a copy of like the ad, for example, for whatever it was you were sending the money for, so you can do the direct relation to what the event was, so you can track it better. Where you're going to run into problems, though, on that, if you don't have a specific receipt, is if there's an HST component to it and you're filing an HST return. HST audits are a lot more stingy as far as receipts go, and very detailed receipts and specifics. So from an income tax perspective, usually you're okay if you can show the inflow and outflow on your bank statements, your bank and credit card statements, and they'll take that as a good backup if you don't have a receipt for something, but HST would be a problem.
Okay, perfect. Yeah, I think on that note, everyone's putting many other great questions into the chat. They're very much situational, so we're going to say that towards the end for
Okay.
our lengthy Q&A. But in the meantime, feel free to return to this Zoom call by, I think, like 3:16.
Yep, let's do that. 3:16. We'll meet
Okay.
back.
See you
Thanks,
all soon.
everyone.
Wow, time flies by when you're having fun, not on. Or do you think you're ready to continue, Kelly? Is everyone
Yeah,
back?
I'm good. I'm good to get going again.
Okay,
Excellent.
friends. Yeah,
Okay,
do your
so
thing.
we're okay, so where we finished off on the last one was talking through all of the self-employed income and expenses. And I'm sure there's probably a whole bunch of questions related to that, which we'll get into a lot. We'll have a lot of time towards the end. I'm going to finish this up where we can get into some very specific questions, which I'm sure will also pertain to some others. And I find a lot of the best stuff comes out when we go through the Q&A section. But I also wanted to touch on some other areas that might impact some other individuals. So rental income. I wanted to talk about rental expenses you can do if ever you end up renting out your place because you're not going to be using it. So you might find yourself going into having to travel for an extended period of time, even a few months, for example, or maybe it's for a long period of time and you no longer need your place anymore and you're going to rent it out to somebody else. Well, there's expenses related to that. So you definitely have to claim any of the income that you're receiving in respect to that, but you can do offsetting expenses to that as long as it's a legal rental. So this is where one of the new measures that came out by the government in this past year with respect to rentals was it has to be something you're allowed to do. So there are some areas where it might be limited. I know this happened to some people with cottages that they had where they were renting it out and they were deducting expenses, and the government's come back and said, well, technically, legally, you're not even supposed to be renting that out. Still got to claim the income that you did receive, but we're not going to let you take expenses because you really shouldn't be doing this. So just be cautious about that and make sure it is a legal rental that you can do. But if it is, then you can, any advertising you did to try and get somebody to rent out that space, you can take deductions for any insurance you've got to do on the property. If you own it, then mortgage interest and property taxes. If you rent it and you're doing like a sub rental to somebody else, then your rent expense can go in here too. Any maintenance or repairs that you have to do in order to be able to rent it out. Maybe you've had to even hire somebody to come in and deal with a plumbing issue, for example. Those are deductions you can take. And if you've had to drive back and forth or take a taxi or Uber or anything like that to go deal with an issue with the tenant that you've got in place, that would be the auto and travel you can use for that. Not for regular back and forth and stuff, but anything specific related to getting your income with respect to that place. Any utilities, if you're still paying the bill for that as opposed to the tenant who's going to be in there, you can take deductions for too. And if it's a condo and there's some condo fees in relation to that too that you've got to pay every month, those would be deductions you can take too. Also, if you've put anything in there for them, so like let's say a washing machine or a dryer, a new fridge, a stove, anything along those lines, those are deductions you can take, but also keep in mind how I mentioned earlier about anything over about $500 that you're spending on. This is where you've got to start to think about the different aspects of if you need to capitalize it or not. Also, when it comes to maintenance and repairs and renovations that you're doing, if it's anything structural, you may not necessarily want to take deductions for that. And you might want to just track it and hold on to it, because when you sell a property that you own, if it's not your home and it's something that's been income generating, there might be a tax impact to that where you got to pay capital gains on it when you sell it. But any of those costs that you've done, then you've put into those renovations that are structural, can now be offsetting some of that income that you're going to have to report. So you definitely want to be tracking those different aspects. And you definitely want to make sure you're declaring it when you do sell the properties. And this is not only rental properties, but also properties that you own. There is something called principal residency exemption. So if it's a home that you live in and let's say you bought it for $300,000, doesn't matter whether you mortgaged it or not, and then you sold it for $500,000. Well, you made $200,000 on that. But if it's your principal residence and it's a home you live in, you don't pay any tax for that as long as you fill out the T2091 form that's on there and you're declaring a principal residency for those years for that property. Each individual in Canada has the ability to do this for one property that they own. So if you own more than one, you have to choose only one of them that you can declare this for, and you had to have lived into it as well at some point in time, and it can't be a fully income generating property or a commercial property. Now, if we go into we go. The short-term rentals I was talking about. So I'm just going to skip past this because we did talk about that. If it's not an actual type of rental property you can do. Now, let's say you find yourself in a position where you're switching the use of a property that you're living in. Again, similar to like how the principal residency exemption comes into play, you also need to file elections with respect to changing the use of that property. So this could be all of a sudden turning it into a rental. You've got to make an election to do that to defer gains. Otherwise, you're creating tax events. And also when you're coming back from it being a rental into being a principal residence again, it creates a tax event that's happening every time you change it from being an income producing property to a non-income producing property. Oh, that was a tongue twister. But so there are elections that you do need to file on those different aspects, but there's also a lot of costs around that you can do. I don't know if there's many people who do fall into that, but if anybody's got any specific questions around that, happy to answer those at the end too. Also, one other little aspect to do with properties is CRA has been cracking down on people who are buying homes, renovating them and flipping them around and selling them within a 1-year period. So just keep an eye on that. Definitely hold on to it for at least 366 days so you don't find yourself into these different scenarios, because capital gains when you do sell properties are only taxed currently at 50%. Eventually, there is proposed measures where it can go up to 66.67%. But what they'll do is if they find you're a person who's flipping properties on a regular basis within 1-year periods, they can tax it as business income. So that makes the whole 100% of it, as opposed to that ratio, becoming taxable for you. So it can cost you double from a tax perspective if you're not taking these timelines into account. Let's get into more from an individual standpoint. So we've got other deductions we can do. So we had talked about foreign income that you might be receiving from outside of Canada. Foreign income can also be considered stocks that you hold on different investments that are outside of Canada too. So it could be a US-based stock, for example. But if there's any taxes that you're paying outside of Canada, you want to make sure you're taking the offset for any of those taxes that you are paying. You'll have to produce proof that you've had to pay the foreign taxes on these different items. And usually how they want to see that is proof of a tax return being filed in that jurisdiction as your proof of the amount of tax that you paid. There are some countries, for example, where there isn't tax returns you actually file, but what happens is the government kind of does it on the back end. I know Canada has considered doing this. I'm not sure that I trust CRA to do it for us with all the issues that they have. So hopefully they don't do that here. But some countries do this. So they might do an automatic tax return for you. And there's foreign taxes that will be declared within there saying your tax bill of how much that you have to pay. And that would be proof enough that can be used in those places. Spousal supports, we talked about how if you have divorced somebody and you're receiving spousal support, that becomes income to you. Well, the same thing works for somebody who's the payer of that spousal support. So you can take a deduction on your tax return because it is getting taxed by somebody else on the other side. So spousal support is a deduction, child support is not. Okay. RSP and first home savings accounts. So when you do contribute to an RSP or a first home savings account, and we'll get into these afterwards as well, there is a deduction you can take. So let's say you put $2,000 into an RSP, for example, or $2,000 into a first home savings account, that becomes a tax deduction for you in the year that you made the contribution. But what's important to understand, first home savings account is not the case, but for RSPs, when you do take that money out later, it will become a tax event to you. So at the time when you need that money, you're not going to actually receive the full $2,000. If you say, I want to withdraw $2,000, because they're going to withhold probably about 30%. They'll withhold off of that. The financial institution will do that and you won't get the full amount. So it's just important to understand that. And it's not always necessarily the full amount of tax you're going to have to pay on that, because it's all based on what your tax bracket is of all of your overall income that you're reporting in that specific year. Donations. So if you're making donations, which I hope we all are because people do need our help, then we can take deductions for that as well. And you can use some that you haven't contributed towards, that you may have done contributions for from previous years. If you've never made a claim in those specific years for those donations, you can do a bit of a catch up for the last 5 years. So they do allow you to do that. And you get about a 15% credit for the first $200 towards donations that you do, and 29% of any additional amounts above that $200 that's in there from a federal perspective. And provincial does have their own range, and it goes anywhere between 4% to 25% that you get on that. Medical expenses too, you want to make sure you're taking deductions for any medical out of pocket you have. So even if you do have a benefits plan, there might be a portion that you're still having to pay. So you can take a deduction for that piece. So let's say they cover 80% of dental. So your bill was $100, your benefits coverage covered 80, but the other 20 you still had to pay out of pocket. Well, those are medical expenses that you can claim as well. If you don't have a plan at all, then the full amounts you can take deductions for anything that you, again, have paid personally. And the way it works as far as how much you can deduct, because not everybody can, it's the lesser of $2,759. That's the number they had come up with for the specific year. That could change at some point, or 3% of your net income. So this is whatever is there on your line 236 of your tax return. That's how it allows whether or not you can take the medical deduction, because they do think people can take, I guess, can eat a certain portion of these different amounts that you can do. Tuition, so for yourself, or if you have any children who are going to school, you can take a deduction for that. For yourself, you can claim the full amount on your T2202. So you do want to make sure you're downloading those from your institutions, usually from the main login page. You can, there's usually somewhere in your My Account that you can download your tax slips, and this is one of those slips that's available to you. So you want to take that deduction for your tuition. If you have children who are going to school and you're paying their tuition bills, you can transfer up to $5,000 a year. The rest of it stays for them to use at a future date. But you can take a $5,000 deduction per child on your tax return, as long as they designate it to you. They just have to sign the back of the form. There's a spot on there for them to say, I'm assigning the tuition credit to my mom, my dad, whoever it is that it's going to be. Only a parent you can do it. You can't just choose anybody. It's got to be a parent or yourself. If you had received a student loan, if you had gone through the government to apply for a student loan and you have interest related to that, usually the interest doesn't start till you're done school, but the loans usually last for quite some substantial time, even after you're done school, to allow you more time to be able to pay it back. Any interest you're paying on that becomes a tax deduction for you too, which is great. Now, let's say you have to pick up and move at least 40 kilometers in order for to take on an employment job or to go to school, for example. Any moving expenses related to that, you actually can take deductions for, which is pretty amazing, for your moving costs that are related to that. Let's say you find yourself having to take care of somebody and support them. This could be a parent, this could be anybody else. There is a caregiver credit that you can claim on your tax return. And it's worth about $2,616 here. And there is a possibility for an additional $8,000 if that person's income is between $8,000 and $28,000 that can be taken on the tax return. There's an actual line item on the return that you can take for this credit. And this is very separate from the disability tax credit. Disability tax credits do have a whole different spectrum of paperwork that has to be done with respect to that. Caregiver credit is not quite like that, but there has to be some reasoning behind it, like a justification you have to do. You just don't have to have like major paperwork and approval ahead of time and all that type of thing to be able to take this one. Eligible dependent and spousal amount. So let's say you have a spouse, you're married, and they don't make any income. Well, they can use your tax deductions, because every person in Canada does get a personal tax exemption for a certain amount of income. It's about $15K each year. It goes up a little bit more incrementally each one of those years, but you get that tax-free without having to pay any tax on that type of income that you're getting from all income sources combined. So if you have a spouse who's not making any money in a year, you can use theirs. So you can have like potentially $30K that you don't have to pay any taxes on. Eligible dependent is, for example, we'll use the case again. Let's say you got divorced and you had children and those children are living with you, you can actually elect to do the same kind of thing with one of those children to run the household and take their exemption as well of their 15K. So you can take 30K in there. There are some specific rules around that too that you can look up. It's called the eligible dependent deduction that you can look up on there. But again, it's going to give you that ability to get up to 30K each year being tax-free, which can be a lot. I wanted to do this little reference chart just to give everybody a bit of an idea of what some of the tax rates are in different provinces across Canada and the different types of income you have and when you're in for your top marginal brackets. So if you're at the highest, as you can see, BC and Ontario are around the same, and so is Quebec. Quebec's just a little bit lower by a couple of points. But our top marginal rate is pretty high. There are some other areas that have, I think there's one that's got a little higher at 54.8%, but our highest tax bracket in Ontario, for example, is 53.5%. So the government actually gets more of your money than you get to keep in your pocket. And this is when you get to the higher, but it's important to understand it's all incremental. So I don't want that ever to deter you from making more money because all of the income at the lower levels is always going to be taxed the same way. It's only as you start to get higher and higher and higher that they're starting to take a bigger cut of the amount that you're getting. And then with capital gains, the impact of that, of how much you're going to get taxed on it, again, at the highest, as you see in here in the second column there, there's the 50% inclusion. So when the capital gains rate changes, it's going to go up to the 66.67% that you would have in there. And if you receive dividends, it's usually a lower income bracket in there too as well. And again, it's only when you get to the high amounts that you're starting to see this high of a rate and percentage that you're going to have. And dividends alone, if you ever only receive dividends as opposed to any other types of income, your first 40K is tax-free. You're not going to pay any tax on that. Whereas with regular income, it's going to be 15K because overall dividends tend to be a lot more tax efficient. Not all scenarios when you get into some of the higher numbers, but they do tend to be a lot more tax efficient. It's the cheapest way to get your money and to pay less tax. But just to give you a general idea, not to scare you, but just to give you a general idea of where they can go when you get into the higher margins. The lowest margin is 20%. So it ranges from the 20 to the 53.53 in Ontario. And I just wanted to show a little ratio versus our US counterpart. Their highest rate is 37%. So just to give you an idea, Canada is expensive from an income tax perspective as opposed to a lot of other countries in the world. So it's not expensive, but with that, it is more expensive from an income tax perspective. But with that, we do get a lot like our healthcare that a lot of other places don't, for example. Now, you may say, okay, we've been talking a lot about self-employed and employees and the different stuff we can do. And I'm kind of confused as to where I kind of fall on the map on here. So it's really important to understand what that is you get. And where it becomes usually really clear is at the end of the year when you go to do your taxes and you're like, what do I do with all these tax forms I received? Well, if you're receiving a T4, then you're considered an employee from that person. But if you have other income that's coming out through T4As, for example, then you're going to be considered self-employed. If you had a contract with somebody in the US, that might come on a US tax slip as well that you've got to claim some income on. And that does still need to be claimed as well. So all sources of income you have, even if somebody doesn't issue you a slip, you still have to report all income sources you have. So really important to be tracking that. And if you do open up that separate bank account, like I've recommended, it'll be pretty easy for you to work out those numbers too, because if you're looking at that bank account and you just go, oh yeah, well, everything that hit my bank account is income that hit that bank account is income that's coming in from the self-employed side. If it wasn't employment income related, then you can do that. Where it's really important to understand is how your taxes change when you've always been an employee before, or maybe you haven't been working before at all in the self-employed side. So when you're an employee in your T4, usually they're withholding, I would say 99.9% of the time, they're withholding tax at source. So I'll never forget the first time I got a job and I went, oh yeah, this is the amount of money they said I'm going to get. And I got my first paycheck. And I'm like, that's not what that was supposed to get. That's not what I thought I was going to get. And it's because they're withholding the tax at source and remitting it to the government for you. So you don't have that tax bill when you file your return at the end of the year. So if you're making, let's say you're making $40,000 a year, they might be withholding 20% of income tax off of that, as well as a bit of an EI and a CPP contribution that's having to be made to the government with respect to that. As a self-employed person, this is where it's important to understand they're not doing that. So if you were an employee and the person who was employing you was withholding all of the taxes, the CPP, the EI correctly, technically you shouldn't have a tax bill at the end of the year because they've done it correctly. As a self-employed person, this is where it's very different because they're not withholding any income at all. They're not remitting any taxes for you at all. So you're going to have to pay that tax bill at the end of the year. So really important to understand how much money you're making throughout the year and starting to put aside that cash flow for the tax bill later. And I usually recommend to people put aside more than you think you're going to need to, and then consider that your extras for money you can put into an investment at the end of the year after your taxes are done, money you can put into even a fund money pool, create little buckets for different stuff you can put money into, a trip, a vacation, anything along those lines, but just really important to make sure you're putting your tax money aside when you're a self-employed individual so you don't end up behind the 8 ball, because it can be really hard to stay on top of it after that if you're starting a year behind where you've got to now make sure you're generating income to pay the tax bill from the year prior. So that's my big piece of advice when it comes to becoming self-employed initially, is making sure you're putting that piece aside. Now, when you are self-employed and you're issuing out you should be issuing out invoices to people for any of the services that you're doing and providing receipts and whatnot. And just make sure that you have a date on those invoices that you've got, a description of the services you're providing. If you're HST registered, you want to make sure your HST number is on those invoices as well. And you may say, well, we're talking about HST here. Do I register for HST? Don't I register for HST? What are the rules around that? Well, not everybody has to register for HST. However, if you have are generating income from a self-employed perspective of $30,000, then you have to register for HST. And that's within what they call, I'll say it's technically like a 1-year period, but it's really 4 rolling quarters. So quarters of the year. And that could even be from October 1st to September 30th of next year. So not necessarily just in the calendar year, but in a 1-year period. So once you think you are going to, once you surpass that 30,000, so you need to track this number when you feel like you're getting close, your obligation is to register for the period ahead. So you have to do it before the next quarter starts to register for it. And then you have to start charging the HST based on the jurisdiction you're in. And if you're in a different province and you're not a harmonized province, then you're going to have to start charging the GST plus PST. And you're going to have to do those remittances based on that. So some of our provinces are and some are not. And then once you do register, you are required to charge HST moving forward until you close that number again. Even if you run through a period where all you're doing is making $100, you're still going to have to charge. If you're in Ontario, your HST rate is 13%, for example, you're going to have to charge $113, even if that's all you made in a whole year, because the number is open. So you must register for it. Some people may say, well, should I register sooner? And the answer is, it's up to you if you want to or not. You absolutely can. It will make tracking your stuff more complex because from a tax return perspective, if you're not HST registered, you're including all of your expenses with the HST value in them. So if you paid for something worth $100 that was HST on it, you're putting in the $113 number. Now, if you're HST registered, you're not putting in the $113 number, you're putting in the 100 without the HST value in there because you're reporting the HST amount separately on an HST return. So it's important to understand the reporting changes a little bit. Now, one of the reasons some people may want to register for HST sooner is it makes them look more seasoned. And the reason for that is if somebody's receiving an invoice and there's no HST on it, they know you're a small guy. because it's quite obvious you're not making $30,000 a year because you're not HST registered. So sometimes when people are trying to solidify themselves out in the public, they might try to register for HST sooner. So that could be one of the reasons sometimes you'll see people registering for HST before that 30,000 point, but just know with that comes a lot of tracking and an additional HST return you have to do a filing for. As I mentioned, there is a T4 that gets issued and a T4A that you might receive as a self-employed individual. Now, not everybody issues out T4As. You really should be for receiving them for every job you do, at least over $500. The requirement is if the earnings are more than $500, you have to issue the receipt, the T4A slip. But again, I've seen a lot of people who don't receive these. So it's important that you're tracking on your side exactly all the income you have and making sure you're claiming that full amount. Now, the government recognizes that as a self-employed person, it takes a lot more time for you to get your stuff together to be able to file a return. So they do give you more time to submit your tax return. So as an individual, if you're not self-employed, your filing deadline is April 30th. If you're self-employed, they do give you till June 15th, but it's also important to understand they want their money still by April 30th. So you need to make at least an estimated payment of what you think you owe by that time frame. At least something, pay a little something towards it if you think there is going to be a bill. Now, if you're in a loss position, obviously there's not going to be a bill because you didn't make money in that year and there's nothing to remit. So the government's not going to expect anything by April 30th and just make sure that you're filing your tax returns by June 15th. Now, if you are married or have a common law partner, then them by default, even though they're not self-employed, will get that June 15th deadline as well. Because they understand, because you do have to report when you're married or common law that your spouse's or your common law partner's income as well on your tax return. So they understand that they have to be done together. And for that reason, they get that extension as well. So both of you get till the June 15th, so a little longer to be able to file. So let's talk about HST a little bit more too, because I find people get tripped up when they are registering for HST. We talked about when to register, which was good. Reporting for HST as a self-employed person, it's going to be due the same time as your tax return. So it'll be due June 15th as well for the HST filing. But again, they still want their money by April 30th. So it's going to follow the same type of thing. Oh yeah, to register, if you look at that phone number, this number, if you're HST registered, this is going to become your least favorite number to call, but sometimes one that you really do need to call, which is 1-800-959-5525 at CRA. To register for HST, you can call them or you can also go online and register. I believe there's a way just to add the account through an online registration now as well. They've made it quite simple. If you are calling into CRA, just make sure you have a lot of time on your hands because you can be on hold for a significant amount of time. So I have a tendency when I have to make that phone call to just put them on speakerphone on hold in the background when I've got some time to just put my head down and do other work at the same time. Now, if you register for HST, there are two different options you have for the way you can report. Not a lot of people know that. So the regular method, which is the typical method that I see most people do, is the amount of HST you collect. So on every one of your invoices that you had is the amount that you'll report, and then the amount that you paid out in expenses. Now, keep in mind, not all of your expenses are going to have HST component on them. But if they did, and let's say you paid out in expenses the same amount as you received in income, then technically you don't have to remit anything to the government. You can keep that HST money that you collected because you had to pay that out as well. But if your expenses are lower, or if not all of them had HST components in there, there might be a bill that you have to pay on there. There is what's called the quick method. So this isn't based on the actual expenses you have. It's only based on the amount of income that you received. So taking your HST amount into account. So in Ontario, for example, it's the 13% HST rate. For the quick method, what you would do in your industry, and there is different amounts, majority of the industries are at an 8.8% rate they use for quick method. But there are other industries that you should look up if you're in a different industry or you know someone in a different industry. Don't tell them theirs is 8.8 because theirs might be different. But basically the calculation works on whatever income you receive. So let's say you received, I'm just going to use a very easy number, $100, but you charged HST of 13% on that. You would multiply 8.8% times $113, and then that's how much you remit. And it's just as simple as that. And then everybody gets a $300 exemption off of that, off the top as well too. But the calculation is that simple. It makes filing an HST return really easy. However, it's not always the best method for people to use unless you're in a high income bracket and low expenses. Because as I mentioned in the first scenario with the regular method, is when you've got those lower income amounts or you're in a loss position, for example, then you would have nothing to remit. Using the quick method, regardless of whether you're in a loss position or not, you're still going to be paying that 8.8% out in HST. So you want to be methodical about which one you choose. I usually suggest that people start out in regular, and then you might want to consider electing to switch to quick method as you get more established and you're starting to create and generate a lot more income and your expenses are starting to reduce. That might be the time to do the switch over, but you do have to elect to do it when you want to switch it. But I usually suggest get a steady at least 2 to 3 years where you can really solidify that you're going to be in that position moving forward, so you're not losing out on any money by switching over the methods. And then my next slide is just going to give you an example of like how some of this reporting happens. So this is typically what you'll see as you're filing an HST return, where on your box 101 is where you're going to list your sales amount, so the amount of income that you received. When you're using the regular method, you do not include the HST value, so you'll just include the sales number without the HST. What's important is that you make sure that this number matches what you're also reporting on your personal tax return for your self-employed income, because they do check that. And they have like a bit of a matching. I think their computer systems do it, and it generates a letter to start asking you more inquisitions into different things if the numbers aren't matching. So you want to make sure that the sales you're reporting here match the income number on your T2125 when you're filing. And then the box 103 is the amount that you've collected on that income up above. So if we use that number again, that I use the $100, then in box 103 would be your $13 if you're in Ontario. And then if you made a mistake at some point in time through a previous filing and you need to do an adjustment, you can do it on that line 104. If you had to. Try to avoid doing that though, because it does spike a lot of questions. Just try and get it right the first time if you can. And then box 106, that's the input tax credits, as you see there. That input tax credits, or ITCs as it gets related to a lot in a lot of verbiage that you read, is that HST that you pay out on any expenses you're paying. So let's say you bought software, you got software, there was an HST component on there. Whatever HST you paid out on all those varying expenses, for example, will total into there. You take your amount from your lines above. You take your box 105, which is your adjustments and your collectible, minus the amounts that you had paid out. And again, there's a box there for adjustments if you have to make adjustments. And that's amount that you remit to the government, if any. And you could end up in a refund position on here if you paid out more. So if you're in a loss position, you could have a refund and you're going to actually get a refund from the government as opposed to having to pay them any money in the year. I will tell you in previous, I would say 3 years ago, prior to 3 years ago, I would have said I never had any concerns with anybody claiming refunds. I will say over the last couple of years that I've noticed that the government is really looking for money because they've handed out so much and they're trying to recover and recoup from that, that now they are looking a lot more scrutiny on people when they're claiming refunds. So just be very sure before you claim a refund that you can substantiate with receipts all the expenses that you're putting in there for the input tax credits. And similar to like I mentioned earlier, when I was talking about the income tax side with receipts, when it comes to HST, they're a lot pickier and they want to see the actual line item on the receipt that shows the HST value to prove that HST actually did get paid on those expenses. So just a little cautionary thing on there. Your documentation is really, really important to substantiate what you do. And if ever you find yourself in a position where you can't make a payment for HST, or for all of your income tax, let's say you've got a bill for income tax and HST, I'm always going to tell you to pay your HST bill first, And the reason for that is that CRA has no tolerance for not paying your HST bill, because technically that was never your money. So if you are HST registered, you really should be putting that 13% aside, because it doesn't belong to you until you filed your HST return, and so you can keep any of it, because you are in essence collecting it for the government. It is not your income. Your income was what you had in box 101, which was your sales number. Anything that's in box 103, which is the HST you collected, really is the government's money and always has been every time you've collected on any one of those invoices and payments being received by you. So really important to make sure you have that set aside for the government to remit. And then again, if you don't have to give them all of it back, then you're able to keep that money when you do the full calculations that are happening. And you do have the ability to select being a quarterly, a monthly, or an annual filer for HST. I usually recommend to people to do it annually, just to make your lives easier, because you don't want to ever find yourself in a position where you're late filing and CRA is asking about it and can charge you a penalty on stuff. It doesn't mean that if you're worried about spending the money as you put it aside, that you can't make installment payments towards CRA. They'll take your money anytime you want. If you want to give them money every single day, they're going to take it every day. So, and if you've overpaid them at any point in time, they'll just give it back to you when you file your actual return. So I do recommend you choose the annual filer, so you only have to worry about taxes once a year. There is the quick method filing. So this is just a little calculation I have on here too, that just shows you just an illustration of basically what I've already said. And this will be available in the slides as well, if anybody wanted to copy later. Now, if you ever owe more than $3,000, one of the things CRA will want is installment payments for the year ahead. So this can be a bit of a hit in the first year that this happens to you, because that year you'll be required to pay your tax bill for that year and then already start installing for the next year ahead. Now, if this isn't your first year, you're not going to feel that hit as much, because then when your tax bill comes the following year, you would have paid your taxes already if you made about the same amount as the year prior. You're only paying the difference of any additional income when you file your taxes after that, if you've been making installment payments. And if you made less, then they'll refund you the amount that you received. This is required anytime you over $3,000. And it could be in income tax, even just as a personal filer, not even being self-employed, or it could be under the HST side as well. And if you don't, then the penalties can get high. It used to always be about 5%. I've been seeing them jump as high as 20% lately if you're a repeated failure to file, and an additional 1% per month on top of that for anything that's outstanding for how long you've had to pay it. And the same thing with interest on money that you owe. Really important to just try and keep that aside, because it can be quite expensive. And it may be cheaper even if you have a line of credit or something that you can get to just pay off the tax bill, so that's not continuing to generate for you. Could be a lot cheaper. And then, of course, don't forget to deregister the HST number when you don't want it anymore. So if you find that you're not going to be in that different area doing the self-employed, maybe you're switching to employment income, or maybe you just realized that you had jumped the gun and decided to register because you wanted to, but you're really not going to be hitting that 30,000 mark, you can deregister at any point in time. You just have to make sure you do your filings up to the date of deregistration. And I just want to remind everybody, like, we all love what we do, or at least I really hope you do, because if you don't, you should really find what it is that you love to do and do it. But don't forget that while you can love what you do, you also have to remember you're in it to sustain yourself, and you can't continue to do what you're doing unless you're paying yourself too. So really start to budget and think about these different aspects. And when you're starting to earn larger amounts of money, you might want to start to consider incorporating. Don't do it too soon, because it's not necessarily going to make a difference for you at that point in time. There's reasons to incorporate. And I'll touch on those lightly today, but not get into too much depth, because I don't think many people are in there. But the most important thing to understand is that with a corporation, you're taxed at a lower tax bracket at 12.2% is really the gist of it, which is a lot less than your income tax. Like, as I mentioned earlier, your highest tax bracket is 53.53%. So you can see the big difference between 12.2 and 53.53%. However, you are taxed higher as you pull the money out of the corporation. So whether that be through salary or dividends, because in essence, as a corporation, you become an employee of your own company. or you're considered a shareholder of your own company. And you have the ability to give yourself money based on how much you're taking out of the company throughout the year and what you need to live off of. So you have to figure out what that number is and figure out if it's really going to make sense for you. But what is really great is the money that you aren't using to live off of on a daily basis that's unrelated to business operations gets taxed at the 12.2%, which is a significantly less amount of money. And there's a lot more money that you can then invest within the corporation through different investment strategies that you can do. So I really just wanted to bring it up so you know that that exists. In the early days, when you're at a low income bracket and you're able to take all the deductions under the self-employed side, and you're basically using every dollar that you're making to live off of, then that may not be the time for you to incorporate. But if ever you're considering it, then you might want to check it out and start to investigate that different area to try and save yourself more money, because I find that middle ground is where it's really tough for people. When you go from being very, very low income to then going into that middle ground before you get really high, incorporating can sometimes be that solution to get you there a lot faster because you're paying that 12.2% as opposed to what you could be paying at like a 40% rate, as opposed to the highest rate on the personal side. You could be paying the 30 to 40% on money you really don't need to be paying that high of a bracket on. So just some food for thought. So with a sole proprietor business, though, this is where the difference is, because with a corporation, you're only paying the income tax rates on the amounts you're taking out of the company, the rest of the 12.2. Sole proprietor business is different, though. Every dollar you make after expenses is taxed, regardless of whether you spend it or not. So that's important to understand when it comes to your reporting for tax purposes. You may say, but I didn't use it all. It's all just sitting there in the bank account. I don't really have the money. Well, it doesn't matter. As a sole proprietor, you are your business. Everything is in your name still. So I'm going to skip over these fast in essence of time so we can get to specific questions, but just know that there is, I do have a blog on with respect to corporations. I think it was on the earlier slide. And if you get these slides that you can go check out if you are incorporated or you're planning to incorporate, that's going to give you a bit of an idea of how to pay yourself out of your corporation when you get to that point in time and how that works. So I am going to skip over quite a few slides here, but I do have them in here and I'm willing to share them with all of you in case you do want any of this information. But even with a corporation, for example, there's a lot of things when it comes to retirement planning that you can do with a corporation too. Again, not going to get into it today, but we can just know that it's there, and you can always reach out afterwards if you have questions around any of that. And there are some illustrations in here, so I'll share those slides with you guys. So reminder on your filing deadlines, employees, April 30th. If you're self-employed, it's June 15th, but you still got to pay by April 30th. If you are incorporated, which I don't think anybody on this today is, your corporate income tax returns are due 6 months after your year end, 3 months after for the payment, similar to like how self-employed, they want your money sooner. Same thing with corporations. And if you are paying yourself dividends or salary out of your corporation by the end of February, you do have to remit T-slips. So personal tax returns can be filed. If you are involved with trusts and estates, the deadline is 3 months after the year end, which is usually calendar. So it's March 31st. T1135s, I did want to bring this one up quickly. It's a form that goes with your T1 tax return, the T1135 foreign reporting. I wanted to clarify what foreign reporting actually is, because people might say, well, I don't own anything outside of Canada, so I don't have to do this reporting. Well, you might actually still have to do it. So what this falls under is if you own any property includes investments, stocks, all those different aspects that are worth more than $100,000, you have to file this form, even if they're through an institution here in Canada, for example, but you're owning stocks that are of that value. And it's based on the cost value, not the fair market value. So there are reports they can give you if you ask them for the T1135 reporting. For any stocks that you've got, it'll show what the cost base is on any of those stocks you have. So if any of them are US based, then you do have to do some reporting on there. Same thing goes for properties. So if you have rental properties or anything, or properties that you inherited or anything like that, that could be outside of Canada, these are things that you would have to report on here. It doesn't create a tax bill, just to be clear on that. Anything you report on this form is literally just to say, hey, just disclosing that I do own these different things. Who knows what the government is actually doing with these forms, but it is something that we do have to declare just to say, hey, I'm here. And if you've ever been a US person, it's very similar to what they call the F-bar on the US side, where you do the same thing for anything you have on the other side of the border. I'm going to do a quick little chat on the different types of investment accounts, so you know when to invest in one versus the other. So the three main ones I want to talk about today are tax-free savings accounts, RSP accounts, and first home savings accounts. First home savings accounts are my new favorite. So if you don't know about them, you want to know about them. And I'm going to tell you why. So tax-free savings accounts. The program began in 2009, and basically what they did is they came up with an amount that you can contribute into these accounts each year. Everybody's on the same level playing field. Doesn't matter how much money you make. You can make a deposit into these accounts. You can even invest in stocks, or it can be sitting in cash within that TFSA vehicle, and everything it grows to become is tax-free to you. When you take money out, it doesn't create a tax event. You don't have to report anything to do with these TFSAs on your income tax returns. The only thing around these you have to be cautious on is that you're not going over the amount that you're allowed to contribute in a year. So for 2024, for example, that allowance was $7,000 that you could have put into this account to do some investment vehicles. I think this is great. It's money you can get out and you can rely on to be able to get dollar for dollar when you need it out of there. So if you had $5,000 sitting in there and you needed it to get by, you could actually withdraw $5,000 and receive the full $5,000 and not have to worry about a tax event at the end of the year. So really great if you're not using these to consider using them. And the amount of room you get each year into the account, it's because every year they give you an allowance. If you had to pull it out, the following year you get that room back. So you can put it back in the following year. You just have to wait till the following year to be able to do so. Now, your room increases each year. As I mentioned, the growth's not taxable, so that you get every dollar that's coming through, and you will get that future time. Now, sometimes you may find yourself becoming a non-resident at some point in time based on the things that are happening throughout your life. So if you ever do become a non-resident of Canada, you're allowed to keep your TFSA account in Canada, but you can no longer generate room in those years. So even if you have a CRA My Account Access, if you don't, I highly recommend you do get one, because it gives you a lot of visibility to everything you can see. It may show you have this room because you haven't declared that you became a non-resident in that year. So just make sure you stop contributing into it at that point, because your room's not going to continue to generate. But it's fine to keep it in that vehicle. You don't lose that ability to hold on to it. And you just want to make sure you're not over contributing at any point in time, because there is a bit of a penalty on that of 1% per month. And if you ever find that you did go over, just take it out right away so that penalty doesn't happen. RSPs are great again. Not everybody is on the same level playing field though with these ones. It's all based on how much employment income you had. So what it means is 18% of whatever, up to a maximum each year of employment income that you had, is what creates the amount of room you have. So if you're reporting losses, you're not generating any RSP room, as an example, because it's not gross income, it's your net income that generates this 18% on here. And you get a tax deduction in the year that you make the contributions. So you can opt, this is a way to do some tax planning too, where if you find you want to reduce your tax bill and keep more of it to you, you have that ability to do so. But it's important to understand that it's only offsetting taxable income, not tax payable. So if you earned $50,000 in the year, to be able to make your tax bill fully go away, you'd probably have to make a contribution of $35,000, because your first $15,000 is tax-free. So to fully make it go away, it'd be the $35,000, you'd have to do that. But on $50,000, you're not going to have to pay $35,000 in taxes. So you just want to be mindful of that it's not dollar for dollar taking away taxes payable, but always a good thing to do. To give you an idea of what the maximum amounts were, in order to achieve that maximum amount, your employment income would have had to have been these high amounts. In 2024, $180,500 to get the maximum room of $32,490 you could contribute. And this accumulates over time, much like the TFSA. If you don't use it, you have that ability to have that room in there. And you don't have to have accounts open and that you're contributing into actively in order to generate the room. It just happens. And then you have that ability always to contribute into there. And through CRA My Account, it'll track it for you. Just keep in mind the current year you're in won't have the latest information. So you have to factor in anything you've done throughout the year because they usually reset around this time each year from the year for the year prior. And if you have been contributing into an RSP, when you do go out to buy your first home, you do have the ability to draw down on it. You just have to pay it back within a 15-year period or take the amount into income over that 15-year period if you haven't been putting it back into the RSP. And this is how houses can become quite affordable if you've got two people going into this, because the latest bill, at one time it was only $35,000 you could take out, and they've now increased this to $60,000. So between you and someone else going into this, if you're both tapping into the RSPs, you could potentially be pulling down $120,000 without a tax effect. That's happening when you're going into buying a house. Lifelong learning plan. This is one piece that I find a lot of people don't know with RSPs. Similar to the home buyers plan, you do have the ability to pull down on it. The repayment term is 10 years without creating a tax event. And you can take up to $20,000 from your RSPs in order to invest back into going into school. So it's $10,000 in a calendar year, up to a total of $20,000. And you can do this for yourself or for your spouse or common law partner. So potentially you could be taking out $40,000, 20 and 20 for both of you. And even if the course that you're taking is only $2,000, you could potentially still take out that much, because they understand that this is about, this is meant for adults who are more seasoned and are out into the workforce, and you're having to step away from income generating activities to put yourself and educate yourself into a new career, because that's what it's for. It's educating yourself into a new career path from the path you were doing previously. And then I'm just going to skip through here to leave time. But I want to talk about first home savings accounts. So for anybody who has not bought their first home yet, if you do not have one of these accounts open, I highly recommend you do. And the reason is unlike the TFSAs and first homes and TFSAs and RSP accounts, the account has to be open in order to generate the room. And you have the ability for a lifetime contribution up to $40,000. And it's $8,000 a year over a 5-year maximum period. So you definitely want to have this open for at least 5 years before you're buying a home in order to take full advantage of it. And this could be you and another person you're going to buy this house into. And what's really great about this is, like an RSP, when you make a contribution into this account, you're going to get a tax deduction for it. And you're allowed to contribute $8,000 a year. So that's up to $8,000 of a tax deduction in a year. Now, if you have, and now if you're pulling it out when you buy that home, and with the RSPs, you do it under the home buyers plan and you have to pay it back over 15 years. With the first home savings account, you do not have to put it back. And it also does not create a tax event, which is amazing. So it really is a triple threat. You really can't go wrong with this. I can't stress enough, if you're going to be buying a home for the first time, you have to get this account opened up, even if you don't have the money today to do it, because you can throw the money that you're saving into it over time as you're leading up to buying the home, throw it into this account, get the tax deduction, because your room is going to accumulate for those years, and then pull it back out, get the tax deduction, and then buy the home with it without creating a tax event and without having to put it back into an account later. You really can't lose on this. And even if you don't need the tax deduction in that year, you have the ability to carry it forward to use in future years when you do have that income to offset. So you really, really can't lose. So if you are in that situation, I highly recommend you do that. If you yourself are not in that situation, you have children, do it. Make sure you're educating them on that, educate your friends on that. Like, this is really important and can save you so much money. So I do highly recommend that to people. And then I'm just going to quickly skip through a couple of slides here, because I want us to get, I want to make sure that everybody understands about the audit piece, and then I think I'm going to open it up to questions. So I want people to understand that there's a difference between an audit and a CRA CRA may review your return, third-party sources. It all really depends on the type of deductions and credits you're claiming. It could be because of your history with CRA. It could be just random selection. COVID benefit reviews, there were a lot of those going on in the last little while. It's all really based on topics that they're doing, or if you've been affiliated with somebody who's doing something funny, that might spike something as well. And there's different types of things that might happen. There's pre-assessment reviews. So before they finish processing your return, they want to check in on something. It could be a verification request because you're claiming something that they don't have in their system, or vice versa. A refund examination. So this is where I was saying be careful with the HST refunds, because usually when there's refunds now, there's a lot more scrutiny on the filings that you're doing, and they might ask some questions before releasing the money. There's also supplemental types of reviews where maybe they've asked you for something and then they want more because they want to learn more about it. The matching is very similar to the request verification program, where something's just not matching between what you're filing and what they've got in their system. And then there's like special assessments of different things that they're doing just based on different program types that they're doing. And then sometimes the post-assessment review. So a lot of those can happen before they actually finish processing the stuff. Then there's post ones. So this is after they've done it. They could reopen potentially another year based on something they found in a future year that they've done for you. And you typically have about 30 days to respond. Sometimes with the pre-assessments, it's 15 days. Sometimes they can be 45 days. So really watch your timelines and make sure you're sticking to them to make sure you're responding timely for them. A lot of common ones that I tend to see come up are related to moving expenses. Sometimes it could be for like different eligible dependents, maybe for the first time being claimed, or the other spouse is trying to claim the same person. So you guys have to be aligned and make sure that only one of you are taking these different aspects. There could be large variations. So one year you had maybe on one line item claimed 20,000, and this year you're only claiming 5,000 in income. So they're like, why the drop? Something funny is going on. Or a deduction the same way. Maybe you had a deduction for $500 and all of a sudden now you're claiming 20,000. They're like, whoa, something funny is going on here. Maybe there's an extra zero in here or something. And that might spike them to try and ask more questions around these different aspects. Donations and medical expenses, very, very common for them to ask for proof on them. And the reason they do is because a lot of people get it wrong. So for donations, they might try to write off things under donations like for GoFundMes. So GoFundMes are not charitable donations unless they're registered with a charitable donation number. So really important to know that when you're making donations, they are not considered charitable donations for tax purposes if they don't have a charitable registration number, and that should be issued right on the receipt that you're getting. Medical expenses, sometimes there's medical expenses that people are trying to deduct that aren't actually applicable. I'm trying to think of an example of one that I might see. So like cosmetic stuff. There might be cosmetic related medical expenses that you're trying to claim. The only people who can do those types of expenses are for reconstructive purposes. And when I say reconstructive, I mean like major reconstructive surgery types of things, not just because you want to do that because you're aging or something along those lines. So those won't qualify. So you just want to be mindful of the different ones. And literally, whenever you're in question, just make sure you get used to the way to search up these different things. Like if you're ever in a like a Chrome or something like that, or a search engine looking something up, always type the letter CRA first and then type the topic that's in there, and something will come up. And just make sure that the sites that you're going to are the Canada.ca sites, and it's going to a reputable site that's going to give you the proper information. Those are really good to go and read through those different things. Also, I will show you the links to my social media feeds, which will also give you an idea of the proper types of links you want to go to, because I do try to link into their credible sources that you can then use for future as well. So you know at least the baseline and the root of the proper sites to go to for information when you need to know something. So it's just really important you're pulling the information from the right sources. There's a lot of information out there when you do searches, and not all of them are correct. So you want to make sure you're using valid opinions. And people will say, well, I called CRA and they said something. Well, don't always believe everything you do there, because I guarantee you, if you called 3 times in a row, you're going to get 3 different answers, or at least 2. So they don't always know the answers either on that side, and they will not allow you to just say, oh yes, someone at CRA told me that. Even if you have an agent number, it's still your responsibility to make sure that you have the proper information and you're doing it right, regardless of who's telling you what along the way. So when it comes to, if you ever find yourself in an audit perspective, in an audit situation, there really is different things that you want to kind of think about. If somebody has prepared your tax return for you, please contact them, because they need to be involved in this process, because they might have made adjustments based on their knowledge or what they were doing based on them sifting through your information, and they'll know how best to respond. So always contact the person who did. You always want to, when you're providing information to them, make sure it's really easy to follow, and it's full of everything they've actually asked for. I mean, they might list 20 different things they need, but they may not all be valid and apply to you. But every single one that does apply to you, make sure you are including all of those things, and make it really easy for them to follow the records and go through each one of those different expenses. You also want to make sure you're meeting any deadlines they've given you. And if for some reason you can't meet a deadline before the deadline comes, make sure you contact them and ask them for an extension. Once the deadline's passed, they may not give it to you. So you got to call ahead of time and make sure you get it. And if you miss that deadline, if you don't make that call, then they will just make an assessment based on you not having any proof. And they'll just disallow all the expenses, which you don't want to see happen. And just make sure you're communicating smartly. And what I say by smartly, I mean, make sure you're giving them what they need, but also don't give them more than they need. Like, they don't need to look into things that are irrelevant to what it is that they're asking about. And make sure you're also holding your ground and be aggressive in your negotiations, but also be respectful when you're doing it too. So you want to be very respectful to the person themselves, but at the same time, you don't have to agree with everything they're saying. So if they're trying to disallow an expense that you really believe is a business related expense, fight your battle, but just do it respectfully, and hold your ground on that, to make sure that the expense can get through, because by default they're always going to go on their side as opposed to your side. So you've just got to prove them wrong, and just give your reasoning and justification for the different aspects of things, and make sure you do provide what they ask for. Otherwise their default response is just going to be, I'm just going to disallow it. And just some final thoughts that I've got going on. Taxes don't have to be scary, and having a tax bill to pay is actually a good thing. I know you don't want to hear that, but it's actually a good thing. It means you're doing something right and you're making money, and there's nothing else to deduct because all this money is going in your pockets, right? So it's actually a good thing. And just be organized and track all your spending as much as you can, just so you can really reduce that tax bill as much as it is possible to do. Tracking is everything. Keeping organized is everything, because without doing that, you're going to miss out on a lot of deductions that you could potentially be taking. And this year I'm going to be launching wine and cheese events. If any of you are interested in attending, you're more than welcome to. It's going to be on different topics where we're going to get really in depth on different items that you want to know. So if anybody's interested in that, just send me an email to newsletters@rosspc.ca, and I'll make sure that you're in the know and know what's happening. And I'm happy to teach you more about different things. And on that note, thank you for listening. And I want to open up the floor for questions if anybody's got questions. And these are the various links to our YouTube channel, which has got information on, like, they're all, the videos are about 5 to 10 minutes tops, on different topics. There is a lot that talks about self-employed in there. If you want a kind of a refresher on just specific expenses related to that in 5 to 10 minutes, there are some really good videos on there that can help walk you through the reasoning behind different things. And then once tax season's over, you're going to see a whole bunch more different things starting to go on our social media feeds for different items. Right now I don't have time because I'm doing everybody's taxes. So it's a little busy around here, but we will be kicking that back up after tax season again. So with that, thank you, and I will open the floor to questions.
Okay. Thank you for that, Kelly. You are so amazing. So, friends, welcome to the tax workshop question Q&A extravaganza. Before we get into the more situational questions, we just had about 3 questions in the chat that really relate to just clarifying some things that you said during the presentation.
Sure.
I'll start off with one question that says, within the $30,000 threshold for HST incomes, do grants apply to this amount?
So grants usually don't. I'm not going to say all don't because it really depends on the contract and the type of grant it is. But they usually don't have an HST component to it, but you do still report the income when you do your HST filing. So it's matching the T2125 value that you are reporting. So you would just list that under exempt income for the amount that you're going to do on there.
Okay, lovely, lovely, lovely. Next clarifying question I've got is, what if you have a mixture of self-employment and employment? What is that due date?
June 15th still. You'll
Okay.
still get the June 15th date, the extended timeline, because you're reporting some self-employment income on there. Once you have any self-employment you're reporting on, you're going to get the later date.
Cool.
Yeah.
And then before we go into situational questions, Luba just mentions that the HSC process is a bit different in Quebec. Just for
It
those
is.
who might not be familiar, could you speak to that just a little bit?
Yeah, so there is the QST component and then there's the GST component. So it is different. So in Ontario, everything's harmonized and there are many provinces across Canada that's the same. From the Quebec side, so if you're in Quebec, for example, you're still using the same concepts with it, but what you're doing is breaking out your pieces. So you're going to have your federal component and you're going to have your QST component that you're going to have to report on. And there's even boxes in there with relation to which sales relate to just into Quebec, how much sales was QSTable, how much was not QSTable. So you really have to be a lot more detailed into those different boxes that you're doing. So you need to know the sales for all of Canada. You need to know them for the province and the outside of Quebec, how much it is for those different ratios. So it's just a little bit more detailed. So your tracking needs to be a bit more detailed. So hopefully that helps. Is there something specific you've got a question on that maybe I can help with a response on? The QST rules are a little bit different as well too, based on taxable versus non-taxable supplies.
I don't think Luba had
No
question per
question.
se.
I just wanted it noted in case other folks were joining in from Quebec. But thank you so much, Kelly.
Oh, you're welcome.
Yeah, everyone.
Okay, so with those questions out of the way, what we're gonna do is we're just gonna like go from the top of the chat downwards, and we've like put all of the questions in a separate Google Doc so that we can keep things organized. And we're just gonna like ask you things, Kelly. Are you ready?
You want to give me 2 minutes?
Sure. Okay.
Give me 2 minutes to get my voice back because it was starting to drop.
So
Give me
maybe
1 sec.
we should do you want to do like a 5-minute break?
Sure. Let's do 5 minutes and then we'll regroup on the situational stuff.
Okay, so everyone meet back here at 4:30. Thanks, Kelly.
Thank you.
Hi.
Hello.
Okay, so now that do we feel ready to proceed with our question
Absolutely.
and answer extravaganza?
Yes, let's do it.
Okay, so I'll start off with a question from Keita. Sorry if I'm mispronouncing your name. Keita says, if I have questions around claiming working from home and claiming office spaces and expenses for my self-employed work as a freelance artist, but also have other regular part-time employed work.
Sure.
And also just asks about like, I have questions about where to claim my money that was given to me as an artist fee, but that's also being used to pay other artists. So there are two things. I'm actually just thinking it might be more helpful, Kate, if you just let yourself unmute and then just ask a couple questions, because I feel like didn't quite get into the specifics, but more so like outlined things that you want to know more about. So
Yeah. Um, yeah, I'm a freelance artist, but I also have like a part-time regular job where I'm an employee. And so I
Mhm.
guess I think I know the answer around the home office. Like if I use like I work from home most of the time for all of like my own personal freelance work. So I guess I'm just curious, am is that still okay to be claiming like part of
Yeah, like I would say if your employment income, like I would just break it down to if you're working in the same space for employment income and for self-employed, if you don't have a T2200, and even if you do, actually, you still want to ratio it based on how much you are using it for the employment income versus how much you're using it for self-employed. So let's say it's 50-50, for example, then you're going to do 50%, only 50% of the amount related to the home office would you deduct under the self-employment side. Now, if you had a T2200 from the employment income side and it was allowing you to have a home office there, then you can still deduct on the schedule T777 all of the home office expenses on that form as well and get the full deduction. So you can do it under both. But if you don't get that T2200 from the employer for the employment income side, then you wouldn't do that part of it. You would only do the portion related to the self-employed. Does that help?
Yes, thank you.
Okay, great. And I think you had another question as well outside of that.
Yeah, I think I know the answer as well, but I just want to clarify.
Sure.
I get so as a choreographer, I've received like fees, like an artist fee. But then I use that artist fee to then pay dancers.
Yep.
Does that just count as like one is income and then the other is a business expense?
Exactly.
Okay.
That's exactly what it is. And depending on the amounts of money you pay out, you might have to issue them T4A slips from yourself, from a self-employed person, because they're working as subcontractors for you, depending on the agreement you have with them.
Okay. I guess that's also, sorry, I have like a third question now about that. Then if I don't receive T4As by like someone else who contracts me, like is that something I should be contacting them and like asking for?
No,
Or
don't worry about asking them for it. Just make sure you're claiming it as income. That's more of an issue for them than it is for you, because they could be penalized for not issuing those slips if it's over $500. But that's a them problem, not a you problem. So I wouldn't worry about it.
because yeah, I don't know, I've definitely never issued a T4A to dancers I've contracted. So
Yeah.
so do you know, I don't personally know how to even go about that, but
yeah, so it's something you might want to consider doing if it's over $500. And if you do a search even just to what that form looks like, it's literally just one box you've got to fill out, which is listing the amount. Even if they charge you HST for it, it's the amount without HST that you're putting on there for the amount that you give them out each year, and they're due by the end of February of each year. That you've got to issue those out based on the calendar year from the year prior.
okay, great. Thank you so much.
You're welcome.
Okay, so we're gonna move on to the next question, which is coming in from Aza. As a performance artist, are costumes created and used for performance considered business expenses?
Absolutely.
Okay, perfect.
cool.
Yeah, because they're costumes, right? They're not regular everyday wear. They're ones used for performances. So absolutely.
I love absolutely as like the catch-all for it.
Yeah.
Okay. Did you have anything you wanted to add or can we move on?
No, that's good. Thank you.
You're
Yay.
welcome.
Okay, next we've got a question from Luba. Can condo fees be claimed as a home office expense?
Yes, they can. So again, just the ratio though of the percentage that's used for the home office in there. But yes, absolutely.
Okay, great. Another absolutely. Rolling right along. Okay, the next one comes in from Chin Yi. For musicians or producers, what about things like laptops that are used for both business and personal expenses and instruments if they were initially bought as a personal but became income generating?
Okay, so assets that are used for both, what you would do is just ratio it just like that. So based on the amount of usage used for business, that's the amount you would capitalize as opposed to personal use. So if you were to say it's 50-50 and you bought it for $1,000, then you would take the deduction for you would add it on there for the $500 instead of 1,000 because it's 50% value that you're putting in there. Now, when it comes to, sorry, what was the second part of that question?
Is yeah, they were initially bought as personal but became income generating.
Yes. So if you bought them initially personal, then you basically sell it to your self-employed business. So you figure out what the current value of it is when you start using it for business purposes, and you can sell it to the business.
Okay, great. Chinny, was that clear? Do you have any follow-ups on that? Okay,
Cool.
We'll just move along.
So next question. SD asks, can I claim as a freelance illustrator if I'm living with my parents in my parents' home, but a portion of the room is my home office?
No, if you don't pay them rent. If you pay them rent, yes.
Okay.
Then you can pay. Then you could write off a portion of the rental fee that they charge you for it.
Okay, SD, what do you think? You got an add-on to that, or maybe move on? Cool.
Okay, well, let's move along. Okay, and then from Luba, are late payment fees paid by a client for a late payment of an invoice issued by you as a freelancer reportable as self-employment income? Are they taxable?
Yes. So if you're charging them an extra fee for that, it becomes income to you on the employment on your self-employed side, because if you're charging them something. Now, if it's a service fee, that there's another fee that you're having to pay on the other end. So like, for example, you're accepting payments like for credit cards and there's a credit card fee. Well, then the fee that the credit card company is charging you, you would take a deduction for.
Okay, Luba, did you have any follow-ups for that?
Just a super quick follow-up. Thank you so much, everyone. I'm sorry I've posted so many questions, but so Kelly, would I then charge them HST on the late fee?
No, you don't have to. So you don't have to charge them HST on the late fee itself. That would just be considered like exempt income that's running through there, or investment related income that you could be reporting separately.
Okay.
You just
Thank
list
you so
it
much.
as like another income kind of a thing. But
Got it.
anything you are receiving, you do have to claim.
Yep.
Okay. Lovely, lovely, lovely. Next question's Chinyi back with another question. In regards to expense eligibility, does conference travel count if traveling to a different place for an industry conference? And in the same vein, where do conference registration fees fall under?
So yes, they do. What you would do is there's a section on the T2125 for like other related items. You could just list out conferences as your descriptive on that as you're filling out the T2125 form, that you can just list it for. So, and because it is industry related, it is related to your income generation. By you going to those, you're making connections and you're learning new things to do with your industry. So they are expensible for sure.
Okay, great. Chinyu, is there any follow-up on that?
No, I think the only other question I asked was what about travel and lodging that's related? So that it's also like if I went to a conference and I had to stay in a hotel, that's also eligible, right?
That's correct. It is. The only parts to that is similar to what I said earlier, is if you're bringing somebody else with you, that's not part of your business and you're paying for any of their travel, like their portion of it just wouldn't be a deduction. It's only your portion.
Okay, thank you.
You're welcome.
Okay, great. And next we have Priscilla. Can travel be Uber, Presto fare, and gas to put into a car that is my parents' car? So I guess like writing off expenses related to those things.
The gas into your parents' car, probably not. But the Ubers and taxis, absolutely.
Okay, and Priscilla, did you have any follow-ups on that? Okay, we'll move
Cool.
on.
So next, Luba's back. Travel that's already been reimbursed by a third party, for example, a gallery, is not reportable as a self-employment expense, is it?
No, because you're getting reimbursed for it. The only way you would put it as an expense is if you're including it in your income number. So if it's in your income number, if you're including that value, then you would do that as the offsetting expense to take it back out. But anything you don't personally pay for, you shouldn't be claiming as an expense because you haven't actually paid it.
Okay, good. I see a thumbs up from Luba there. Okay, and Stella, can something like a gym membership be deducted if the justification is training for physical requirements of my work?
If it's a requirement of your work, then yes, it is. So, like for example, if you weren't doing it, you generating that income would be in jeopardy, and you can justify that, then you can take the deduction for it. But if not, then no. So, for example, if your contracts for this year in particular have nothing to do with you doing anything physical or being in front of a camera that requires you to be in a certain amount of shape, then you can't take that deduction. But if you are, and that is a requirement, and the only way you'd be able to get that contractor to generate that income was to be doing this activity, then yes, you can.
Any other questions there, Stella?
Thank you for answering that. I think just to clarify, I work as a photographer, and I recently have started doing weight training with a trainer because of the toll the work is taking on my health and my body. So I'm not sure where that lands me.
So are you saying it's because you weren't able to carry the camera the way you were supposed to, so it required you to build up your muscles and stuff? I would say as a photographer, it's a little harder to justify. I think a CRA auditor would go at you head on that one. I mean, you could try and justify it and say, well, if you have like any I don't know, documentation from like even a doctor or something like that that's saying in order to be able to do the camera work, you have to be able to be keeping this up, and that'd be, I would say, is a way to justify it. But if you have nothing else to back it up, it might be a little hard as a photographer. I would say if you were in the realm of being a dancer, for example, well, yeah, you have to, I could see that. Or if you were an actor, for example, that was trying to go for a role that required you to have a six-pack and you had to go and get a personal trainer for that, then absolutely, right? So like, it's all about how you can justify it. So if you can get some sort of a doctor's note or something related to that, to justify that you need to be doing this training in order to be able to conduct your work, then I would say then it's justifiable. So it's up to you how far you want to take it.
Okay, thank you.
You're welcome.
Okay, let's continue. So SP is back and asks, can I still expense materials and subscriptions even if I had no art income in the year 2024, but have a history of receiving artist grants and artist fees in previous years?
If it was just grant income, I would say no. But if you had other fees that you were charging people, I would say yes, if you can still say you were actively seeking out other income.
SP, what you think?
Thank you.
Awesome.
You're welcome. So just make sure you are actively seeking it out and you're not putting yourself into that loss position for that third year in a 5-year period. So I just want to reemphasize that you don't want to be showing the losses for that third year in the 5-year period.
So if I have a record of like me applying to, opportunities, would that be good enough to justify?
Yeah.
Okay.
Absolutely.
Okay. Thank you.
You're welcome.
Okay, great. And we're back with Priscilla. Okay, this is pretty specific, so I'm just going to try and read it out to you. Priscilla says, my grant line from which I'm being paid says, in quotes, staff wages and MERCS, MERCS, $5,000 for project coordinator. What is MERC's, MERCS, and what does it mean in terms of filing taxes?
I don't even know what that term is. So it sounds like, so I'd have to look that up. I don't know what that specific term is. It's probably something related to the grant type. But if you want to email me later, I can see if I can find out info for it on you.
So
I just don't know it offhand.
Okay, we'll move along.
Cool. Keita asks if you are contracted for something by a non-for-profit that is over $500, should they still be sending T4As?
So that kind of ties into the last question I think I spoke to someone about, which is technically they really should be still, but it's not your concern. As long as you're reporting the income you're receiving, that's all that matters. That's more a them issue than a you issue.
Okay, perfect. And Julia says, if you pay an artist more than $500 out of a grant you have been awarded, do you have to issue a T4 for them? If so, how does one do that? I think we covered that a little bit.
Yeah, that's the T4A slip. So anytime it's over 500, if you have a subcontractor who's helping you carry out work, you really should be doing it. I'll be open and honest with you. Not everybody does. Most people don't, especially as a self-employed individuals. Corporates do it more than the self-employed individuals do. But the requirement is still there in black and white. I don't really see CRA going after a lot of people for not doing it, but if they were to tell you you were supposed to do it, just so everybody's aware, the penalty can be, it's all based on how many slips you should have issued, and it starts at $100 a slip. So it's it can be up there if you're not. I wouldn't worry about what you haven't done in the past, but I would suggest you doing them moving forward.
Thank you for that. And sorry if you've already spoken to this. I'm unsure how one goes about issuing a T4A. Is that done through the CRA website?
It's not done through the website itself. There's a form that you can download and you can paper file to them. It's called the T4A slip. So there's a T4A summary, which basically combines all the slips you're issuing out into as a total. And then there's the slips themselves that you fill out. And it's all you need to do for a self-employed, for a subcontractor, somebody who's working for you, is fill in that box fee for services as the amount without HST that you're putting into that amount, and then submitting it out. And then it's your responsibility to send in the main copy of all the slips in the summary to CRA, and the form instructions, when you look it up, will actually tell you where to send it out to. And then you've got to issue out one to each of the people that you're issuing a slip to, so they know the slip exists and is with CRA.
Thank you so much.
You're welcome.
And Julia, you're also, I think, our next question too. You had a question about FHSAs. You want to just ask it?
Yes, I was wondering if you create an account, this first home buyer's account, savings account, and you never end up being able to buy a house, are you penalized when you remove the funds from that account type? Or
no, so you're not penalized. You have options of what to do with it. So what you can do to have zero effect to you is actually they'll allow you to transfer it over into an RSP. So you can just move it into an RSP and then there's no effect. You don't get an additional RSP deduction for it because you've already gotten a deduction for it when you contributed into the first home savings account, but you don't get penalized for it at all. You can just roll it into an RSP account at that point. If you were to take the money out though, then it would create a tax event if it was taken out for anything other than buying a house.
Thank you.
You're welcome.
Okay.
Okay, and our next question from Claire is, if you're making and selling product on a regular basis but don't make a large annual income from it, is there a level where it would still be considered a hobby and it's better not to claim it?
I would just say you just don't claim as long as you're showing some income over the 5-year period, like for 3 out of the 5 years in a 5-year period, you're fine. What I would just suggest is if you don't see that there's going to be income getting generated moving forward, it's always important to report the income. because it is your obligation still to report the income if they don't deem it to be a hobby, but then just cap your expenses and just always bring it to like $1. Like never take more than never put yourself into that loss position. That's what I would recommend, because you never know what could end up happening with it. And if you received anything, you do have to declare it. So just take the expenses up to the income level.
Okay, and she had just a follow-up on that. She said if she didn't keep receipts for expenses, is it ever okay to use bank statements instead?
From an income tax perspective, you're probably okay, but moving forward, definitely start to keep those receipts. It's HST, you're not going to be able to get through with just bank statements. They won't accept them.
Okay, great. Claire, did you have any, is that clear? Did you have any follow-ups on that? Okay.
Lovely. Okay, so next is a pretty situational question from Clarence. They say, I have design hobbies that I want to build a freelance business for this/next year, but I'm just starting out. In 2024, I have a full-time job. I have a T4 slip that I will file this year. With my hobbies, I earned around 4,000 gross income in 2024, which I know is nowhere near the $30,000 threshold. Do I claim this? I'm not sure if I should claim self-employment or whether this income belongs in line 130.
It would be self-employment for sure. You're going to claim it as the 4,000. That 30,000 threshold is only for HST, not for income tax. So you're still going to claim it as the self-employment income on your T2125 for the 4,000. And if you have expenses, you can offset it against there. If you don't, then still claim the 4,000.
Thank you.
You're welcome.
Okay, and the next up we have Maria. I'm not exactly sure what she means by this. The question for children artists, do you know if CRA understands that there is a lot of expenses because we pay for 2 people to go to studios or eat, etc.? My experience is when I call the CRA, they have no idea about children actors. Okay. Maria, feel free to jump on if you want to clarify this.
Thank you. I guess is because when you're a child actor, I find that because he has to pay when we go to Toronto, we have to have 2 tickets to go on the train, and then it's 2 people feeding each other because like he's underage. He's 13 years old. So I don't know. And when I call CRA and ask questions about his account, I get an actor, like that's very strange. So I don't know how. I haven't been audited for expenses for the past 4 years. That has been an actor, but I don't know if they understand that 2 people have to go and they like. What is your experience if you have any people who are in the acting but they're underage?
Yeah, so this comes up a lot that I've seen. They don't understand the industry at all. And a lot of times they don't understand the age factor that comes in. You have to educate them on that and just hold strong on it. If ever you find yourself, take the deduction, because obviously they cannot go if you don't go with them, right? So take it for both of you, because that is what's happening. Now, I would say if there's 2 parents going, that might be where they could say, well, only one really needed to go, right? Not
Makes
both,
sense,
right?
yeah.
But
Yeah.
one person for sure is going to have to go with them. So that is a valid expense for sure that you should be able to do. And I would fight that to the end. I would definitely do that. And if ever you get audited and they give you a hard time on it, just reach out to someone like myself or another accountant who can help you fight it. Because it's really just hold your own on that and just say, like, listen, it's impossible for them to go.
Impossible, yeah.
It's impossible for them to go alone and do this. They are minor. That's where it comes in. Yeah.
Okay, perfect. Thank you.
You're welcome.
Cool. Okay, we just have a few more, and we're actually almost done, which is great.
Okay.
Brigitte asks, are submission and application fees deductible?
Yes, if I'm assuming I know what it is. So submission and application fees, I'm assuming in order to generate income or to go to something that you're going to be able to pitch that's going to allow you to generate more income. So the answer would be yes.
Okay, Brigitte, does that answer your question? I love a yes as an answer.
Yeah. Where/which type of expense would that be? If you know.
I mean, I would throw it in under subscriptions or office expense. Office expense is always a really good kind of catch-all for a lot of administrative related stuff. I just say throw it in office expense. When in doubt, if it's an administrative related thing, throw it in office expense.
Gotcha. Thank you so much.
You're welcome.
Okay, and then next up we have Heron. How important is it to hire a CPA or bookkeeper that has industry specific knowledge or expertise?
I would say it's pretty important that they at least understand the industry, because there are some nuances around it. And if they don't know how to, if they don't understand the specialities within that industry, it can be tricky. And even more so if there's ever anything cross-border, you for sure want to be talking to somebody who understands the industry and also understands the difference in the cross-border taxation of when it becomes an issue or not, because it can. And it does come up a lot and some people miss it.
Okay, Heron says thank you.
Yeah, but I would say if it's pretty basic and you're not doing any industry specific type of deductions, it doesn't really matter as much. It's when you're starting to get into the industry specific items, that's when it can become an issue.
Can I just follow up on that question
Sure.
about cross-border since you mentioned it? Sorry, I know it's not my question, but because you brought it up.
Sure.
Does your firm, or are you like familiar with cross-border
Yeah,
type
we do
stuff? 'Cause I
cross-border.
think- Yeah, I guess I personally I have some difficulty finding people who know like cross-border.
It's a niche in Canada. There's not many of us who do it. And like even ourselves, like we're very limited on how many we can take into the department because there is such a need for it. But if there's general questions and stuff you have around that, I'm happy to try and guide you in the right direction.
Thank you.
You're welcome.
Actually, Chinyi, while you're here, your next question, basically you had a question about HST and like income generating personal items.
Oh yeah, sorry. I think when you answered my first question, I muted my laptop and I actually didn't hear your response, but I had somebody else whom I know on the call and they told me that you answered my question.
Okay.
But I wanted to like just follow up on it because I think you had mentioned that, for example, for an instrument or a laptop that I initially bought for personal use that becomes income generating. When it becomes income generating, I can like sell it, like
Yeah,
quotation
you got to
sell.
value it. You got to come up with some sort of evaluation on it at that point, because obviously it's not still worth the same value as it would have been when you bought it. So if you bought it 5 years ago, it could have depreciated in how much value you would be able to sell it to a third party for. And that would be what you'd basically sell it to your company for, to then be able to expense it, right?
So if I'm not a registered, like I'm not incorporated and I'm
Yeah.
not registered for HST, I'm like an individual, how do I like sell it? Do I still
It's basically a back end paper route is what you're kind of doing. So it's just a matter of really just logging it and saying, yeah, I gave it to the business and this is my baseline of how much I was selling it for. So for example, on Kijiji, if I were to sell this to somebody, this is how much they would have paid me for it or something, for this asset. Or if I was to buy it from Amazon as refurbished or something like that, like this is the cost basis I'm using, and then you would take a deduction for it in that year.
Okay, thank you.
You're welcome.
Okay, truly last few. Would physio and massages or other physical therapy be a medical expense deductible as a movement artist?
It would be, I would say you throw that under medical expenses, not under the sole proprietor expenses. So you would take it under the medical expense size.
Can I follow up? What does therapy fit under anything or no?
Therapy would be under medical expenses too if it's a registered therapist, depending on the therapist type.
Great, thank you.
You're welcome.
Okay, and then Karat says, if you're part of an arts collective and had group expenses, can you still claim your share of the expenses if you weren't the one to pay directly, having reimbursed the person who paid through e-transfer?
If you can prove the e-transfer was related to that and you have the original receipt, I would say yes.
Karat, did you have anything else on that?
No, that's great. Thank you.
You're welcome.
And then lastly, so Paprika was actually curious to see if you could go back a bit and talk just a little bit about incorporation. It was a part that wasn't really addressed, but you know, at least
I know we skipped over that. Like incorporation's got a whole lot of stuff on there to do. What I would say is if she's still on here, I'm happy to answer any specific questions. And if I'm happy to even have a chat with her too. If she wants to set up a time to chat with me about it, I'm more than happy to do that. And I won't charge you for it. Like just reference this presentation and say Kelly said I could set up a time to chat with her about this.
All right, Paprika, how's that sound? Great. Well, I guess it's exactly 5 p.m., which is amazing. Kelly, thank you so much for this. You always make taxes, which are so scary, seem a little less scary. And we're all really, really grateful.
Well, I'm happy I can do it, and I hope everybody took away something from it. And remind me if I forget to send you the presentation slides so you can distribute it to anybody who wants them.
Totally. So we're going to be sending this and also publishing the recording of this presentation within the week. So expect to hear from us soon. Yeah, aside from that, maybe we can just let you all enjoy the rest of your days.
Sounds good.